So recording is on progress. If you don't feel comfortable sharing your camera, I totally get that. If you don't feel comfortable sharing, your voice, don't hesitate to use the chat. And once again, as corny as this sounds, this is definitely a free space. And if you have any qualms or inquiries or concerns, you let me know. And of course, I'll be happy to help you out. So with that said, let's get this show on the road. So I'm going to zoom in just a little bit. These questions, we're going to do them as a team. I'm going to give you, a minute or two to answer them. I'm going to try to, play some. It's like we're playing a, what's it called? Like a TV game, like we're all having fun with it. So we're going to go through these questions. I'm going to give you like a minute or two to answer them. This is very representative of what was in previous finals, what was in previous midterms. So being able to understand these questions and to ask the right questions, to clarify it will be extremely relevant. So when a customer places an order, ISMA Helps requires a deposit equal to the full purchase price. However, ISMA Helps does not recognize revenue until the completed crash course is delivered. In August 2021, ISMA Helps received $3,000 in deposits. The balance in its deferred revenue account was $500 on August 1st, 2021. And it was $750 on August 31st, 2021. How much revenue did ISMA Helps recognize during the month of August 2021? Now, before I give you guys some time to try this question, I'm going to just identify a few points that are relevant here. So one thing we see here is that we're requiring a deposit equal to the full purchase prior to actually, serving our customers. So that could be interesting. Then they really iterated that ISMA Helps does not recognize revenue until the crash course is delivered. In other words, this deals with the matching process, which is something we've covered in chapter 3. The matching process means that revenue is only recognized once an action, once the sale, once whatever service was needed is provided in full to the customer. All right, so for example, let's say you ordered a shirt from me, but you paid me in full prior that I gave you the shirt. Well, revenue will not be recognized until I actually deliver the shirt to you. All right, so that's just one little thing to understand. Now, in August 2021, so that's our beginning date, ISMA Helps received $3,000 in deposits, okay? And then the balance right before we received these deposits was $500 in August 1st. And we're also telling you that at the end of the month, $750 was left in that same account. Now I'm asking you, how much revenue did we actually recognize during said month? So with that being said, on an exam, you will be honestly given to really do it in time, about 3 minutes per question. So I'm going to give y'all 3 minutes to really try it out. Give me A, B, C, or D. I'm pretty sure y'all have already started. And from there, we're going to work it out as a team. So what do you think the answer is? A, B, C, or D?
Real quick, are we gonna go through like the multiple choice first and then the longer base question? Okay, perfect.
Perfect. Yes, exactly. There's 1 minute and 30 seconds left. And obviously, do not feel pressured to answer it within the 3 minutes. If just try your best, and from there, we'll all do it together. So we got one answer. We got one answer. You got everybody here has. We got 2 answers. Okay, 30 more seconds. 30 more seconds for everybody to give it a shot. I need 2 more potential answers in the chat. 2 more people to participate, and from there, we'll give it a shot all together. And I'll walk you through my approach. Okay, perfect, perfect, perfect. So the time is up. Now, William and Sarah, the answer is definitely C here. But why is it C? And now I just want to go back and identify also why it's not, sorry about that. There you go. Sorry about that. I'm trying to use my pen. My pen's not working. Give me a second. I'm trying to fix this really quickly. Whatever reason. Anyways, who cares? Okay, so the answer is C. Now, why is it C? So what I want you to know is that we received $3,000 in deposits, okay? Now, at the very beginning of the month, we received $3,000 in deposits, but we didn't actually provide that service yet. So in our deferred revenue account, we had an initial balance, we'll call it B, of $500, okay? Then we know that because we had people who wanted to purchase the crash course, we had to add $3,000. And I'm so sorry that my mouse writing isn't the best. But what this means is that prior to recognizing any revenue, our account in deferred revenue was equal to 3,500. Okay? But we're telling you that at the end of the month, we only had 750 left. Oh, this is gruesome. That's how bad my writing is. But we had 750 left, okay? So what we want to do here is we want to know, well, what happened from 3,500 to 750? All you have to do here is, because we know what's our ending balance, but we don't know what happened within that time frame, that thing that happened is actually all the revenue we recognized, because we're eliminating deferred revenue. Once revenue is recognized, it can no longer be deferred revenue. So because we knew our ending balance is of 750, and we knew that we had an account of 3,500, all that we had to do was do 3,500 minus 750, and that gives us 2,750, i.e. answer C. Now, is that okay for everybody? Does this make sense? Julia, does that make sense to you? Amazing. So the approach here is really, you could use a T account, which we'll cover in detail within the Excel part and within my YouTube videos that you can check out as well. But the idea here is that we're trying to use a rationale, okay? We're trying to use a rationale. So with that being said, this seems to be okay with everybody. So the answer here is C. Now, I included this question, but this was a typo, because bad debt expense will actually be covered in your second midterm. So don't worry about this question too much. But if you come back for the second crash, we're going to go really in depth in bad debt expense. We're going to cover every single thing it means and how we get to it. But for now, this is not relevant to us. Okay? So with that said, let's look at the third question. Let's look at the third question. So which of the following transactions increases profit? Okay, so increases profit under the accrual basis, but does not increase profit under the cash basis. Okay, this is a loaded question. It's more of an ambiguous question as well. But we're going to try to make sense of what we have here. Okay, and I'm going to give you 3 minutes to, I'm going to give you a minute and a half to give it a shot because there's no like math. This is more like conceptual. So you'll take a minute and a half to think about this, maybe even go through your notes and try to find an answer for this one. All right, so you have a minute and a half. And if you have questions, just let me know within that time frame. Meantime, I'm trying to figure out why this is not working. Oh, okay, we got one answer. All right, nice. We got one answer. I'm liking this. Sorry if I'm playing with my screen at the same time. You know, I'm just trying to make sure my thing works. But okay. Okay, so with that being said, the answer here is D. The answer here definitely is D. And what I want to do here is I want to explain why is it D and what does that make sense and what is this all about? This idea of accrual basis versus this idea of the cash basis. Okay, so okay, this is really not working. Okay, so with that being said, the accrual basis versus the cash basis. Now, when we're comparing the two, we want to know that the cash basis, essentially, we're really discussing this idea of we're only looking at when we receive cash. It's as simple as that. The cash basis literally means it's an accounting process used by small companies, used by yourself or myself if we started a business, in which we don't have any accounts receivable or any accounts payable. We're only looking at this idea of cash. But then when we look at the accrual basis, all right, when we look at this idea of the accrual basis, we're trying to get a sense of what happens to our revenues, what happens to our expenses, and how do we actually distinguish the recognition of those two. And when we're trying to get to this idea of delaying a recognition of revenue or delaying the recognition of expenses, we create this thing called accounts payable. We create this thing called accounts receivable, because now we're dealing with transactions that are recognized before cash is actually received. Okay, let me give you an example. Let us say that I purchased this beautiful water bottle from you, but I didn't have cash. Okay, I didn't have cash yet. Under the cash basis, you wouldn't actually recognize anything because cash was not exchanged. But under the accrual basis, you would recognize it, as you learned in Comp 17, because we have what we call an accounts receivable. You're expecting to receive money from me in the future, and you also provided a service to me. You actually get to recognize that. So in other words, you already know that our answer here has to deal with something relative to accounts. Okay, so you already know that it could only be something like B or D because we have this idea of accounts. Okay, now we want to see the distinction between the two. Once again, we said that it would increase profit under the accrual basis, but it wouldn't increase profit under the cash basis. So what does this mean for us? This means that if I give you this water bottle and it actually is an accounts receivable, but we did provide revenue, that would actually move towards our profit. So if we literally get a sense of what D's like or what B's like, B says that a collection from a customer on account just means that you were expecting accounts receivable and you got it. If we look at that journal entry, all that's happening is that cash is being debited and accounts receivable is being credited. But if we look at D, D says that we sold something to a customer and we actually ended up selling it on account. Therefore, we did get that revenue, but we didn't get the cash yet. So in accrual basis, that would actually drive revenue because we did provide that service. But under the cash basis, nothing would be recorded. So this is a long way to say that the sale of a merchandise on account or any sale on account would increase profit under the accrual basis, but would not increase profit under the cash basis because one looks at accounts receivable, whereas the other does not. Does this make sense to everybody? Is the distinction between the two very clear? Amazing. So this is super relevant, and this is going to help you make sense of your Excel, of your journal entries. So before we move on, is everybody okay with that? No questions, no anything? Amazing, good. You guys are doing amazing, answering all the questions correctly. Now this one's fun. This one says that which of the following statements is true? A, only permanent accounts are closed at the end of the accounting period. B, only temporary accounts are closed at the end of the accounting period. C, all accounts are closed at the end of the accounting period. Or D, only the retained earnings account is closed at the end of the accounting period. Also, there's none of the above. So you can take a minute, and I want to know why this is correct. Or, I mean, which one is correct? Which one is true? Oh, it's working now. Hey, okay, maybe it's B. Okay, we got a lot of people saying B. All right, so y'all are pros. Okay, but Sarah said C. Okay, this is interesting. Amazing. It's like black magic. My thing is really not working. Well, anyways, the answer here is definitely B. Now, why is it B? The reason why it's B is because, first and foremost, temporary accounts already in its name says that it's temporary. And what we mean by temporary is that that's an account that is only being used, that's only stacked up within its specific accounting period, okay? Whereas all accounts, like for example, assets, those accounts are not being reset to zero after an accounting period. In other words, if you had $500,000 worth of land this year, I think it's all very, very fair to agree that next year we're going to have the same land if we don't sell it for the same value, all right, in our books. However, our expenses this year may be very different than our expenses next year. And our expenses this year is likely to be different from our expenses last year. Another example that's very evident is revenues, especially for companies that are growing. Ideally, our revenues would grow every year. Therefore, our revenue is temporary for that period. Like that amount of revenue that we got within that specific accounting period is literally relative to its accounting period. 1 year's revenue, 1 year's expenses will not be the same for next year's revenue or next year's expenses. So with that in mind, what we want to do is we want to be able to close said temporary accounts. Those accounts that will change from 1 year to another, from 1 month to another. So that's really important to understand. Everybody okay with that? Quick yes in the chat. Fairly easy concept to understand. Amazing. Good. Perfect. Now, let's look at the next question. Which of the following statements best describes the matching process? A, assets should be equal to liabilities and shareholders' equity. B, revenues are to be recognized when they are earned and realized. C, revenues and its expenses that were incurred to earn that revenue should be reported in the same accounting period? D, debit must always equal credit, or E, none of the above? What answer do you think is correct here? This is interesting. I like it. We have some conflicting thoughts here. We have E and D. Okay. We got a C now. Okay. We got 3 different answers. I need some sort of consensus. What y'all think? What is the answer here? Maybe 2 other people want to give it a shot. Okay, now we have a rationale by William. It's a fair point. It's a fair point. Maybe who else? Who didn't answer here? Julia answered. Okay, maybe Nicholas could give it a shot, or Sarah could give it a shot. Okay, now we got B. We got another B. What about you, Sarah? What do you think is the answer here? Sarah Albatar. What do you think? Type it in the chat if you have an idea. You're gonna be the decision maker. Okay, well, maybe B. Okay, so these are good answers. Like I'm sure everybody has a pretty good rationale here. Now, what I like to do once again is I'm going to take a lot of time to be boring and talk about the theory. But what I do want to say once again, and everybody here knows this, the matching process, it really means that revenue and expenses are only to be recognized when incurred. And incurred is a broad term. Okay, so just by knowing this on the exam, if you see assets should be equal to liabilities in shareholders' equity, we already know that that's no bueno. That's not it. It's definitely not A. And from there, saying that debit must equal credits, we already know that, yeah, sure, that's correct, but that's not what we're going for. So now we only have B, C, and E left. And everybody here had answers related to B, C, and E. So let's try to go through them and break them down. B says that revenues are to be recognized when they are earned and realized. This definitely, essentially, it definitely suggests, this definitely says one portion of the matching process, but this does not discuss this idea of expenses. So it's true, but how true is it? And here we're trying to say what best describes the matching process. So if we look at C, C says that revenue and its expenses that were incurred to earn that revenue should be reported in the same accounting period. Now, this is definitely a tricky one, but that is true. And C is more representative of the answer because it discusses this idea of expenses. And if you have read my notes and you've annotated them, my notes say verbatim that expenses are costs that are associated to the quest of earning revenue. Expenses are only done to actually further or drive revenue. This is something that you're going to cover much further in broader comm courses, but this idea of expenses is that it has to be directed towards earning further revenues. So with that being said, C is the most complete answer, right? And that's why it's a better answer. But B is definitely true, but C is better. Sorry about that. So with that being said, do you have questions or maybe like ideas about this question? Like something
I have a question. What threw me off was the word incurred.
Yeah. Incurred essentially means like aggregated. It means earned. So if we say revenue was incurred, that means that revenue was actually like gathered or received within that period of time. So like I incurred debt. That means I received, I acquired, like I really aggregated debt. So incurred is just another way of like saying gathering, getting, having during a period of time.
Okay, thank
And
you.
can it be said like earned too?
Yeah, 100%. Like
deferred is unearned and then incurred is earned.
Yeah, ish. Like when you see incurred, really just think about this idea of like something being like added together. So debt could be added together. Assets could be added together. Like they could be, mashed up and compiled together. That's what you want to think about incurred. Like expenses were incurred, revenue were incurred, stuff of that nature. It's always towards the same, path. So, any other ideas, questions, concerns, thoughts? Seems okay. Good.
Actual question.
What's up?
So deferred, okay, the thing between deferred and incurred, I'm having trouble with that. So deferred is basically when it's unearned.
Oh, okay. So deferred, oh my God, my writing sucks because my pen doesn't work, but deferred means that it's something that's literally pushed back into the future, right? We're not looking at it right now. Incurred is not really like related to this topic of deferred versus another topic. When we talk about deferred like expenses or deferred revenues, we usually like compare that to accrued expenses and accrued revenues. Incurred is just like a verb. It's like a term. It's literally like incurring something. It's kind of unrelated to this concept of deferred revenues or accrued revenues or deferred expenses and deferred revenues. What I want you to understand here is that deferred revenue is revenue that hasn't been recognized yet. Deferred expenses are expenses that hasn't been recognized yet, but this is really related to adjusting entries vis-a-vis rent expenses or wages expenses, stuff of that nature. And then typically when we look at accrued revenues or accrued expenses, this is something where you're literally not going to really get a journal entry on that. There are no like accounts called accrued revenues or accrued expenses that will be held against you in this semester. This is something that you're going to see much further away. So don't stress about that. What you want to see here is that deferred revenues and deferred expenses are things in which you're going to have to try to understand and build journal entries with, and that accounts payable could be incurred, deferred revenues can be incurred, anything can be incurred. I can incur debt, I can incur this. So just don't mix incurred with accrued. That's one thing I'd like to say. And if you have a follow-up question, I'd be more than happy to answer because I did say a lot of stuff.
Thank you. It was very clear.
Okay, perfect, amazing. So once again, by the way, if you have questions, once you review this recording or maybe towards the end of this crash course, literally do not hesitate to ask me. You could ask me on Messenger, you could ask me if you want to have like a quick video being done, like where I explain something, just let me know. So with that being said, let's look at the following question. Which of the following is a temporary account? A, retained earnings. B, deferred revenue. C, accumulated depreciation. And D, interest expense. What is an answer here? So we got William with an answer. William is quick-witted. I like that. We need two more people with a potential answer here. What can it be? Julia with D. Okay. One more. What do we think? Okay, Nicholas has that answer too. Yes, the answer here is definitely D. Now, for the sake of being fully comprehensive and exhaustive, retained earnings is definitely an account. It's not a temporary account, but we will be looking at it when we discuss this idea of temporary accounts. But retained earnings does not, get reset to zero from an accounting period to another. So 1 year retained earnings will not be set back to zero. So already it's not a temporary account. Deferred revenue is not a temporary account. It's definitely not being reset to zero after an accounting period. So therefore, a year to another will not have a deferred revenue set back to zero. That's literally impossible. And then C, accumulated depreciation. Well, that can literally not be brought back to zero. A really good example is like your car. Every year your car depreciates. Well, you can't say, you know what? No, I don't want it to depreciate anymore. Let's bring it back to zero. That's not how it works. What I like to do is use like a logical perspective. And for that reason, interest expense, that could be brought back to zero after an accounting period or after a year. And once again, we know that revenues and expenses are considered to be temporary accounts. So this is just another way to break down this question. All right, I'm assuming everybody's okay with this. So last but not least, which of the following conditions must exist for an item to be recorded as an asset? A, the item is not owned or controlled by the company. B, future benefits from the item cannot be reliably measured. C, the item must be tangible. And then D, the item must be expected to provide future benefits. Everybody here's a gangster. Exactly. The answer is definitely D. Once again, in the definitions in my notes and probably in your PowerPoints and in course, you knew that an asset is purchased or gathered because we want to have future benefits for our company, for our collective, for our movement. So it's obviously the answer here. It's obviously D. Okay. So what we're going to do now, we're done our multiple choice questions. I'm going to take 10 minutes to answer maybe theory questions that you may have before we begin our Excel, because we have 2 hours, and I think that 2 hours is plentiful to jump in some Excels and get a really good sense of what to do. And if you have any other questions about the multiple choices that we've done, go for it. And if we have no questions, we could go straight to it. So any questions about concepts or something that you want to cover within the next 5 to 10 minutes? Feel free to share if there's something.
Could you go back and just re-explain the third questions about the accrual basis and the cash basis?
Yeah, sure, for sure.
Because I know you said cash basis when there's only cash and there's no like accounts receivable, accounts payable, and accrual basis has those accounts.
Yeah.
But
So
I just don't understand the part with the increased profit.
okay, perfect. Okay, well, actually, we could just use this stuff. So profit, if anything, I can make it. Yeah, whatever. Okay, by the way, yeah, everybody, really quickly, when you open your Excel, I'm going to answer your question, William. I'm just going to give you a quick rundown at the same time of how to make your Excel look good and not give you, a disease. Because the way we get Excel from the very beginning, it looks like trash. So what I do is I press Control A or Command A. So I select everything. I bring my width a little bit bigger. I bring my height a little bit bigger. And this applies to all your cells. So now already it's a little bit bigger. It looks nicer. Okay. So back to Command A, you could change your font to the font that works best for you. I like to use Roboto. Verdana is a great font. Use the font that looks good for you and that actually works with your eyes. So for me, I think that's the best. You could even increase the size. Then what I like to do as well is to set my alignment to middle and to set my text to being centered. And then also I set everything with this little, this little thing that we see right here, this $sign, I set everything to $signs. So now things look a little bit better. It could be much worse. Okay. So to answer your question, William, so what is profit? And I'm taking this time just to give you a better sense of stuff at the same time. Profit actually stems from our income statement. So it stems from our statement of earnings, and we could also call our income statement. All right. So now another trick for you guys is that we could gather a bunch of cells like this, then press merge and center, and boom, it looks beautiful. All right. So when we look at a statement of earnings, we look at revenues. Okay, then we less our expenses, and that's going to give us our profit. Okay, so just like this, we know how to get profit. So now, somebody joined. Sorry, let me just add him or add her really quickly. Perfect. Okay, so now we know how to get profit. Let's see what happens to our statement of earnings under the cash basis. Okay. And this is going to be a really good way to get a sense of Excel and a really good way to get a sense of what these two things are. All right. So once again, we know that we have our revenues, we know that we have our expenses, and we know that we have our profits. Okay. But in this case, our revenues can only be recognized once a transaction is done in cash. So, for example, we're only going to recognize we're literally only going to recognize this transaction once we receive cash. Like if you come to me and you say, hey, I want to buy this iPhone, but I'm going to give you cash in 5 years, or like in 5 days, you're not going to look at that transaction yet. You're not going to account for that transaction yet. You're only going to account for that transaction when you receive cash, okay? So if we have this scenario, okay, this scenario, let me just write it down here. Receive cash for iPhone 5 days from now. This scenario would do nothing to your revenues and obviously nothing to your profit. Therefore, your revenues are not getting bigger, they're not getting smaller, therefore your profit is the same, okay? But then if we look differently at a scenario within our accrual basis allows us to use accounts receivable. Our accrual basis allows us to use accounts payable. Essentially, this means that we could actually recognize a service or a product being sold prior to receiving cash. So now under the accrual basis, if I said, hey, I want to buy your iPhone for $500 and I'll give it to you in 5 days, what you're going to do is you're going to do this. You're going to do debit accounts receivable. Sorry about that. Accounts receivable. And then you're going to do credit. You're going to debit accounts receivable. And then you're going to credit your revenue, right? For the amount of $500 and the amount of $500. So in this case, although you're not receiving cash, you are still acknowledging revenue. You know that you did a service. You know that you provided that product. And for that reason, as you can see, we credited revenue. Our revenue is going to be plus 500. Assuming no expenses, that would mean that our profit would be plus 500. And that's the difference here. That's like the insight. This idea that if we sell something on account, we still get to create revenue. Therefore, we get more profit at that specific time than if we were using the cash basis, because the cash basis would only look at that journal entry, look at that action once we receive cash in hands. And that's the difference between the accrual basis and the cash basis. Does that make sense? Long story short.
Yeah.
Perfect.
So. Yeah.
Perfect. So this was also a great opportunity to show really quickly how to play with Excel. I have time for one more question before we move towards the Excel part. Does anybody have any other theoretical concepts or things that you're not quite sure about that you'd like to cover?
I don't have any questions about topics, but before you start the long questions, can you show like how you do your template again?
Yeah, sure. No problem. No problem.
Perfect.
So we're going to restart. Okay, so this is, let me just write this as accrual. Such that, because you're going to have access to this file after. So I'm just taking the time to, make it look good. Okay, so Q1. All right, so when you want to do your little template here, once you're doing, your exam, you want to be able to do as follows. So just let me, clear up my screen a little bit. All right, perfect. Sorry about that. Perfect. Okay, so now we have our screen. I'm assuming this is big enough for everybody to see. So what I do when I open my Excel prior to my exam, or if you want to create a template before you start your exam, you could do the following. I press Command A or Control A. The first thing that I do is change my font. The font that I like is Roboto, but you could use Arial, you could use Calibri, you could use Verdana, whatever suits your eye. If you press right here, you have all the fonts in the world. And if you have time, play with it tonight, kind of like play with it during the weekend and get a sense of what you want for your Excel sheet. I love Roboto, so that's what I'm opting for. I have really bad eyes, so I put it at size 14. All right. Then I want my stuff to be aligned at the middle. So I press this thing right here. Also, do not hesitate to stop me. If something's not clear, let me know. Then I put my text at the center. Then I press this little cash button right here, so money sign. such that everything I input is equal to, well, just returns dollars, okay? Now, the last thing that I like to do is play with,
When you press the cash, the dollar sign, will it put the dollar sign in front of every single value you input?
yeah, exactly, yes.
But when you do like a balance sheet, aren't you only supposed to put the dollar sign on the first one and the last one?
It's
Or
fine.
does
Like,
it doesn't matter?
yeah, no, for Excel, it's fine. Well, another thing I want to note is that the teachers want to make sure that you understand. They know that you have an hour or like an hour and a half to only do the Excel part. So they're not, OCD on this. So don't worry, it's totally fine. So now the last step is to look at our width and look at the height of each cell. I think that this is way too small. So I like to play with the width. So you go right here and you could, make it as big as you want. For me, I think like 160, 180 is a fair point. And then you could adjust the height. So you press this, and then you could bring it to something that pleases you. I think that 40 is not bad. And like that, we have an Excel that we could use that looks nice and that makes us feel comfortable. Was this clear for anybody? Like for everybody? Like, does this make sense? Can we start the question, or is there something else that you want me to walk through? I'm assuming it's fine. Okay.
I actually have a question.
Yeah.
We don't, like, if I don't want to use Excel, I don't need to use Excel. I could just go straight to a Word document, right?
Yeah, 100%, 100%. It's just like Excel does the math for you. So Excel serves as a calculator, but if you're much more comfortable doing Word, then 100% go for that.
Perfect. Thank you.
All right. So now let's give it a shot. Let's try this long question together. Let's get a sense of what we want to do here, and from there we'll strive together. All right. So let me just get to my stuff as well. So give me a second. I'm just going to open my stuff so I could give you important notes as we progress as well. Alrighty. So when we look at this question, so this question really deals with a statements of earnings. There you go. This question deals with a statement of earning. Sorry, it went back. So we have Tom Bird Company. Okay. It completed its first year of operations on December 31st. Okay. Because this is the end of the fiscal year, the company controller prepared the following tentative income statement. And with this, you get a bunch of information. What I'd like to address is that there's a little typo right here. This is supposed to be 114,000. Okay. So let me just write that down, but then the rest is okay. So we have this tentative statement of earnings. So we have our rental revenue. I guess this is a real estate company. We have our expenses, all those different expenses that we need to consider. And then we have our total expenses and we have our net loss at the very bottom. There are a few points at the bottom that we need to consider. You are an independent accountant hired by the firm to audit the system and review its financial statements. Consider the additional information you've discovered. So from A to B to C, all the way down to G, we have a bunch of journal entries that we're going to have to prepare and from which we're going to have to make an adjusted statement of earnings. Okay, so we have requirement A and we have requirement B. The first one's asking us to prepare journal entries for all the additional information provided, therefore A through G. And then we have B, which is from that, we need to be able to create a correct income statement. All right, so with that being said, we're going to give it a shot. We're going to do it together. And really, this part is not going to be as much like, hey, what do you think? It's going to be, here's how I would go about it. Tell me how you feel about that. And we really work as a team, as a collective to identify these different elements. Okay, so with that being said, let me just change my title here. And once again, do not hesitate to ask me any questions that you may have. It would be my pleasure to answer them. All right, just tell me to shut up.
Is this going to be sent to us?
Yeah, 100%. Every single thing, the files, the PDF, the Excel, you will all have that afterwards. Okay,
Perfect.
amazing. So let's begin with requirement A, which was prepare the journal entries. Now, once again, I definitely suggest that you have your Excel open such that we're able to go through this together. And like that, you can get a sense of how comfortable you are with Excel. So first thing that I would like to show you, by the way, is that you could merge, your cells such that it's like nice and cute. You don't have to do that, but I just like doing that. It makes me, it eases my OCD. So with that being said, we have journal entry A. We have journal entry A, and it says that we have unpaid wages for the last 3 days of December. Okay, we have unpaid wages for the last 3 days of December, and they're amounting to $310, and they were not recorded. Okay. Now there's a few clear insights here. We have unpaid wages. Okay, and it was from the last 3 days. Okay, and they're amounting to $310, and we said that they're not recorded. Now, under the matching principle and all the models that we have, we know that expenses must be recognized once we actually use them in the quest to earn revenue. So if we said that the unpaid wages were done in the last 3 days, so we actually used our employees, although that sounds weird, therefore it means that we actually incurred those expenses, but we haven't made that journal entry yet. So what this means is that before today, we had wages payable, okay, that existed. And now today we need to look at our wages expense. So with that being said, we're going to do the following. We're going to debit our wages expense because remember, and if you see my YouTube video, expenses are always debited and revenues are always credited. So when you look at this question, it's extremely obvious to us that we have wages expense. We have an expense that we did not record yet that we need to record. So for sure, 100% expenses will have to be debited. So you already have half of the answer correct because you know for sure that wages expenses is equal to 310 for the last 3 days and that they haven't been incurred yet. So we have to recognize them. So that's the first part. Now, when we're debiting wages expenses, we're typically, like almost all the time, going to do the following. We're going to credit wages payable because we had wages payable that we've made in the past, and now we get to credit them because they're not existent anymore. So with that, we have wages payable for the following amount for the amount of 310. Now, a few points that I want to make here is that, once again, debits always have to equal credits. But this idea here is that when we're doing adjusting entries, and this is very much adjusting entries because this is at the end of the accounting period, no cash is involved. Let me say this one more time. When we're doing adjusting entries at the end of an accounting period, no cash is involved. So you know for sure that we're not crediting cash. What else can we look at that's related to wages expense? It can only be wages payable. The reason why I'm saying this is that let's say you don't understand the logic applied here. You know that there are always pairs of accounts together. For that reason, we know that A is done as easy as this. Does this make sense to everybody? Say yes quickly in the chat. I took a lot of time to explain this, but I want to make sure that this is simple and clear. Amazing. Good. Now we have B. All right. This is how I do my my journal entries. You don't need to use this model. It's really up to you. What makes you comfortable? All right. So now we have B, and B says that the unpaid $400 telephone bill for December has not been recorded. Okay. So it hasn't been recorded. There's an unpaid $400 telephone bill that we just, we didn't look at. So once again, we're looking at this idea of an expense that we did not recognize. We did pay that amount, but we just did not record it yet. So simply, what are, what it's going to look like? It's simple, right? You always debit your expenses. The amount is straightforward. It's utilities expense. And the same thing here is that if we're debiting expenses, it's like 90% sure that we're going to have to credit our payables. And if you don't understand why, I could show you why in a second. I'm just assuming everybody knows this. So we debit our expenses. From that, we know that our utilities payable is now gone, such that we have the following journal entry. And please, don't hesitate to.
I have a question. Why wouldn't you call the transaction a telephone expense? Like, why wouldn't you debit the telephone expense?
That's totally fine. You can definitely do that. Typically in accounting, they want to make it like very like more macro, very general. So they add that into its utilities, but like that's totally fine if you write that. It's just
like I could do debit telephone expense and credit telephone payable.
Yeah, you could definitely do that. I would suggest using utilities, but it's gonna work. You'll be fine.
Perfect. Thank you.
I have another question. Like from the practice questions, like sometimes like for the T accounts, there won't be utilities payable. It'll just be accounts payable. So is it okay if we put accounts payable, even though if it doesn't say on account?
100%, it's fine. Like it depends on the question. That's what I'll say. If they don't have anything and it's like a question where you need to plug in your answer, I get it. But if you know that it goes as a utilities and that's what you've been shown, I say just go with that because that's what's you're gonna be like given on your exam. And accounts payable is it's like highly different than utilities payable in a sense. Like it's just
okay, perfect.
So
yeah, I just wanted to make sure that because like sometimes it like makes it up. So all right, thank you.
100%. And like everybody, by the way, like I didn't like preface that, but listen, in Comp 217 and all the other accounting schools in the world and blah, 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 there's so many different names for the same thing. So don't worry if your name is slightly off. You don't need to memorize these things. Just be in the same ballpark. Obviously, we're looking at expenses, so you need to include expenses. But if you write something that's slightly different than utilities, like you're chilling. But just try to remember as much as you can. And if you can't, just be highly logical. So with that being said, now we have C, okay? C says that depreciation on rental cars, okay, amounts to 23K for the current year, and it was not recorded. Now I think we all know the spiel. We know that something has not been recorded yet. We know that depreciation is definitely an expense. So for that reason, we have the following. Oops, I can't type. So for that reason, we have the following. But what's really important here is I'm going to ask you, what do you think will be credited here? What's going to be credited here with depreciation expense?
Accumulated depreciation.
Exactly. Yes, 100%. Amazing. Yes, perfect. You are all pros. That's exactly what's going to be credited here. Okay. Another quick tip for everybody here. You see how this cell is like it's impinging on other cells? What you could do is you could press this right here twice, and it's going to expand it to fit it. All right. That's a quick little tip. So if it's like going out of the cell, you could definitely do that. It's going to allow you to make it look clean and nice. So with that being said, yeah.
Sorry to interrupt you.
Yeah.
For the accumulated depreciation, shouldn't we put like what's the accumulated depreciation, like the rental cars, because that's how my teacher taught it.
Yeah, you could definitely do it, especially if you have a bunch of different depreciation expenses, then for sure. In this case, we know that there's only one thing, so we go with, you could do that. But yeah, it's like in this case, if you feel like you need to do, like, if you feel like you could do more, do it. You know what I'm saying?
Yeah.
It only adds to your understanding. It only shows that you're like, totally on the ball. So you can if you want, but it's not obligated, okay? So with that being said, the amount here is 23K. And that's amazing. Okay, so we have that. So now we have another journal entry. Now we could look at D, and D is like super interesting. D is really like relevant, and it's like maybe one of the harder questions, like in terms of what you may have, but it's super simple. And I'm gonna show you how to break it down in a second. So D, interest on $20,000, okay? $20,000 with 10%, okay? So essentially what they're saying here is that we have this note payable of 20K. It has 10% interest. It dates from October 1st. And they're saying that it's not recorded, okay? And they're telling you that the full amount of interest is payable on the maturity date. Now, this is a whole lot of blah, blah. But what you want to know here is that we have this debt, this note payable, this liability worth $20,000 that we started in October 1st. And we know that there's interest to be paid on this debt that we incurred that we have yet to record. Okay. So now we have an idea of what we're looking at. And what I used to do when I had these questions and I wasn't very familiar, I used to just write down everything that I knew, right? What do we know here? We know we have a note payable. We know that we have interest that we need to pay on that. We know when it started. Amazing. Then what else do we know? We know that expenses can only be recognized once we've actually incurred those expenses. And I'm going to ask you all a question. Do you think we should recognize expense for the whole year, so the total interest to be paid? Or should we only look at the expenses that we've incurred since October 1st to December 31st? Because that's the only time in which we actually, utilize that debt. And that's the only time we're nice. Okay. So my spiel is done. Amazing. You guys know exactly what to do. So you only want to look at the period of time that you actually, used. So to make this interesting, we know that we're looking at 3 months because we have all of October, all of November, and all of the December. So yes, essentially you would do your note payable, right? It's $20,000. If you want to do this on your calculator, you know that the interest due is equal to 10%. So by the way, you could press this right here to set this cell as a percentage. Then you could type in 10, is going to give you 10%. There's just one way to make it look nicer for yourself. And then you know that the months passed since October 1st. And this we could write it as a little number here. You know that 3 months have passed. So you know that you could do the following. You could do 20,000 times 10% times 3 divided by 12. And that's going to give you your total, okay? Your total actual interest expense. Okay. So like that, you're able to find the value you need. And then when you have this, you're able to create your journal entry. So with that, once again, we know that interest expense, if anything, we could actually just, but you know that your interest expense has to be debited. Because of our math, we know it's equal to 500. And we know that we have interest payable. We have other interest to pay. But from that interest that we have to pay, 500 has to be eliminated. So because of that, we have 500 here as well. And just like this, you're able to solve probably the hardest question you're going to have for a journal entry. It's as easy as that. Now, do we have any questions related to that? Is there any ambiguities, or was this fairly simple for everybody?
I had a quick question just about recording it, because I'm pretty sure my teacher said in class that for when we do the journal entries like this, even though we can use Excel to do the calculations like you did, we have to still write out what we did to get to show our work, sort of thing. So is there an easy way to just kind of paste that formula you did, or
Yeah, what you could do is you could write for example, there are a bunch of ways to do this. You could write a note at the bottom, and you could write that little formula that was added. You could say 20,000 times 10% times 3/12 equals 500. And you can write it as a little note underneath your journal entry. Or when you paste this, I'm gonna show you at the same time over here. Like let's say I wanted to paste this onto my my thing. Okay, let's say I have this. I'm gonna show you how to paste something also. So let's say you had all this, right? What you do is you're gonna press copy. You're gonna go on your Word document. Then you're gonna right click. You're gonna do paste special. You're gonna do PDF. Now this is added to your Word document. Then you could say, hey, note $20,000 times 10% times 3/12 equals $500. And if you're really like super, like you have a lot of time, you could say, you know, blah, 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 blah. Here's why this is the case. You can make it look cute. You could even do this. You know, you can do that and all that good stuff. Like,
Okay,
that's
so
one.
we can literally just rewrite out like what we did on the Word document. That's totally fine.
Yeah,
Okay,
like
thank you.
that's totally fine. So that's, by the way, one way to add all of your stuff here. And then Sarah said, can you please explain what is the difference between the interest payable and expense? Okay, sure, no problem. So yeah, how do I, okay. So we could all agree that in this case, so let's add a note right here. So I'll just do something really quickly. Okay. So here's like a note. We all know that our note payable was equal to $20,000. We know that we had interest due that was equal to 10%. So the total interest payable on this, like the total interest we were going to pay on this debt that we incurred, will be equal to, obviously, $2,000. So at the very end, the person that gave us this debt, the bank that gave us this money, is expecting $2,000 worth of interest. Okay, but that $2,000 is payable. That's what we owe them. We owe them at a certain date. But right now, we know that if we have our interest expense, so that's actually what we've incurred within that timeline, we know that that interest expense is only representative of the time that we actually been having this debt over the 12 months, over that year that we had it. So like, for example, length of debt in months, right? We know that it's equal to 12 months that have passed since debt is equal to 3. Therefore, how much time has passed in percentage is equal to 3/12. So only 25% of the time has passed. Therefore, we only owe them 25% of that interest, right? So what do we owe them? What do we owe in expenses is equal to 25% of that $2,000, right? Because we know that expenses are only incurred within that timeline in which we were actually using it towards getting revenue. That's why we only look at 3 months over 12. And that's the difference between an expense and a payable, because we know that all of our expenses at one point will be equal to 2,000. But right now our expenses are only equal to 500 because only 25% of the time has passed. So that's one different way to look at it. Does this make sense, Sarah? Got one message. Perfect. So yeah, payable is what we need to pay in the future, and expense is like what we paid, what we owe in terms of like, you know, our expense. So it's like a little bit different. Perfect. Amazing. That's a great question. I'll put this here. Okay. So let me just. Okay. So now we have E. E's an interesting one. So the deferred rental revenue account at December 31st includes $4,000 to be earned in January of the next year. Now, I want to ask you, do you think we should do a adjusting journal entry for this? Yes or no? We have one answer.
No.
Exactly. Now, let me ask you why. Why don't we recognize this?
Because no transaction has been made yet.
Exactly. Like what happened here is that nothing's actually happening. We're just telling you, hey, there's deferred revenue that you're going to earn in the past, like in the future. But deferred revenue, that journal entry was actually done in the past, right? Because we were supposed to get revenue, but we never got it. So we already made that journal entry. This would only be a journal entry if that action of not getting revenue yet happened like right now, like happened on the day of like we're adjusting this. So at E, there's nothing to be done. There's no adjustments to be done. And what you would do on an exam, you would say, simple as that. No journal entry required. And like that, that's over with. And then, not last yet, but F. F is the following. F discusses this idea of maintenance expense. And this is fun. So maintenance expense includes $1,000, okay, which is the cost of maintenance supplies still on hand at December 31st. These supplies will be used in the next year. So this is an interesting question, right? Because we're telling you that maintenance expense is at $1,000 at the end of the year. This is like a really complicated way to tell you that the ending balance for maintenance expense is equal to 1,000. All right. But what we tell you in our like partial income statement is that maintenance expense is equal to 12,000. So what happened between 12,000 and 1,000? What I want to do right now is I want to use this as an opportunity to show you how to build a T account. Now, this is not something that's required on the exam, but it's a really, really good way to empower yourself in your thought process. And that's something that you're going to have to do on your final. So let's take this as an opportunity to understand what's happening to our maintenance expense account. Okay. So what I like to do, for example, we're going to do it right here on the side. So we have our maintenance expense account. What I do typically is I take 4 cells, I merge them together, okay? Then I add a bottom border. And just like that, we're starting to have something that looks like a T account. Then I want to look at what's our beginning balance. And just to make this actually like even more like really clear, we have 2 sides to a T account. We have merge in center. We're going to merge in center here. So we have 2 sides to a T account. We have the debit and we have the credit. So what we know in this question is that we have our maintenance expense at the end and we have our maintenance expense, which was given to us before any adjustment, okay? So because it was before we made any adjustments, can we all agree that we could call it like our beginning balance for the sake of this question? Like for the sake of this analysis, are we okay with that? Amazing, cool. So what is an expense? Is it a debit or is it a credit? What is that? What's an expense? Debit or credit? Just for fun, you know?
Credit.
An expense is a debit or credit.
Oh, sorry, debit, sorry.
Debit, exactly. So
revenue is credited.
Exactly, there you go, amazing. So because we know expense is debited, we're gonna add that in our, just like this, give me a second. We're gonna add it on our left-hand side because we know that debits have to go here and we know that expenses are debited. So for the sake of this question, we're gonna say that our beginning balance, okay, for maintenance expense is equal to 12,000. Okay. Now, another thing that we know is that we told you Oh, well, maintenance and supplies in this case is like the same thing. Like they're saying that maintenance expenses and supplies expenses are like in the same bucket. Okay. So like just group them as like one idea. This is like more of a typo in their question, but like maintenance and supplies are like one and one. And in this case, anything that's expensed has to be expensed, right? Because that's what we know. If it's expense, it has to go as a debit. And then the credit that we're going to do, you'll see why we do that. So what I want to iterate here is that, let me show you. What I want to iterate here is that we also know what's left on hand at December 31st. Now, can we all agree that December 31st is like the end of our accounting period? And because it's the end of our accounting period, can we also agree that that's our ending balance? Are we okay with that? Yeah, okay, cool. Now, we know that our maintenance expense, that's or like the cost of supplies left on hand. So our maintenance expense for that is equal to 1,000. So can we agree that like our maintenance expense of 1,000 will be our ending balance? And because our ending balance is of 1,000 and that's positive, that would be on our debit side. Like, are we okay with that idea? Does that make sense? That we would put, our maintenance expense on hand, what's left of our supplies on hand, which is positive, we'll leave that as a debit because it's positive. Like 1,000 obviously should go here. Are we okay with that? Like, please let me know if that doesn't make sense and I can try to break it down. Like, does this make sense to us that we have these two values that go here?
I'm a bit confused because can't we just do 12,000 minus 1,000 to get?
Oh yeah, of course you can.
Okay.
Yeah.
Okay, we could, right?
Yeah, totally.
Okay, perfect.
Just show like the rationale of why that makes sense. And how can we apply that to a T account? Because we have time and because I want to make sure that when you're thrown a curveball on your exam, you could get that extra 5% and drive that impact on your grade. So this is really interesting because now you get to see like your logical interpretation of this question could be applied to something that's weird, like a T account.
Also another question, why didn't we do that for the rent and the utilities expense?
So you could have done that, but because I wanted to give you something that was quick and easy for a question that could be a little bit like more considered hard, that's why I applied like a quick, simple formula to it. But you can do that. You literally, it's the same idea. We have rent. Well, what's going on in there? Like, what's our beginning balance? What's coming out of that? What's our ending balance? A T account can be done to everything. Right now, what I'm doing is I'm showing you a bunch of different ways to tackle the question. As you did, you use a mathematical equation to do so. We could also use a T account, right? So that's the perspective.
Yeah, but what I'm asking is because utilities expense is 4,000 on the statement of earnings, but we debited and we credited 400. So wouldn't we have to do 4,000 minus 400?
Oh, okay. So that's actually going to be at the end, but you're ahead of yourself. Yes, exactly.
Oh,
So
okay, perfect.
Exactly.
Perfect.
You know what? You're a pro because that's exactly what we're going to do.
Thank you.
Exactly what we're going to do at the end. Hell yeah. So this little gymnastic is also something that's going to be able to give us the opportunity to make our adjusted whatchamacallit, statement of earnings at the end. So now the last step here is like, we know our ending balance is of 1,000 and we know our beginning balance is of 12,000. So what happened for this to get to this? Well, it's simple. That means that we had, an expense equal to 12,000 minus 1,000. Sorry about that. We had a use of supplies. We had a use of supplies, right, of 11,000. And that's why what's driven at the end is equal to 1,000. And that's how we're able to see what's actually happening to our account here. And this is an easy way to see what's going on. That's like how I would go about it. What I'm going to do though is that this is slightly off, although the general sense makes it works. So somebody send me a message on Messenger just to clear this up because the technique is a little bit off. But the idea is that yes, you could do 12,000 minus 1,000, and that's going to give you your use of supplies, i.e. your supplies expense. But just send me a message on like Messenger for me to clear that up because that's slightly off. But the idea here is that your maintenance expense would be debited for 11,000, and that your maintenance supplies, in this case, would be credited for 11,000. There's a slight, misconception there, but don't worry about that. I'll give you a little note after the crash, but the idea remains the same, and I'm sure everybody's okay with that. So that's for F. All right, so now we could go to G, and G is like super duper simple. We know that we have our income tax expense of $7,000, and the income tax will be made, the payment of that income tax will be done next year. So essentially, they're literally feeding you the answer. And the answer, essentially, what you want to do here is, you know that we have an income tax expense of $7,000. No trick here. All you have to do is the following. And you will get to your answer. This is like super easy. They're always going to give you that, most of the time. So it's simple. So with that being said, now we've done our requirement A. We went through all of the journal entries that we have. Now I want to see if we're okay with this. Or like, does this make sense to us? Was this like, was this simple? Yeah. Amazing. Cool. So now we could make our statement of earnings. And I'm going to show you how to make a statement of earnings in a quick and effective way. So one thing to note is that they gave us a partial statement of earnings. They gave us something that we could use as like our template to move forward. Okay. So with this, how do you make a statement of earnings? Start with that. And how do you make it easily? So what I like to do is I like to take 3 cells, just like this, press merge and center, 3 cells, just like this, merge and center, 3 cells, just like this, merge and center. And the reason why is because we know that the name, we need to add it at the top. We know we're doing a statement of earnings. Yeah, same thing, literally same thing. So like if you want, call this an income statement, right? So with that, we could do it just like this. And just like that, we have our heading, okay? We have our heading for our friend here, okay? Now this is just me being extra because I want it to look nice. Okay, this is just me being extra. We don't have to do this. I just like it to look nice. It's just a me thing. But on the exam, you won't have time to add colors and stuff, but this is just, me trying to be cute. So if you remember, when we were here, we know that our statement of earnings deals with revenues less expenses, and that's going to drive profit or losses. So already from the bat, you know that we're looking at revenues, expenses, and we're trying to see what's our net profits or net gain or net loss. So the first scenario, the first thing that we want to add is our revenue. In this case, it seems like we only have one thing that relates to revenue, and I'm going to use a different color to highlight this question. We know that we only have one element that relates to revenue. Okay, so with that being said, all that we need to do here is that we could write rental revenue, right? And it's fairly simple. In this case, rental revenue is equal to 114,000. Simple like that. That's all you have to do. You already got a few points there, okay? Then we need to look at our expenses. What's happening with our expenses? And just to make this a little bit, smoother, I'm gonna do this such that it's clear for you afterwards. Okay, so we have our rental revenue, we have our expenses, so we have our total revenue here. Now, what we want to look at is that once we were looking at our partial statement, we had all these different expenses. Now, when we make our income statement, we need to look at all of these different expenses. So what I'd like to do, if I were you and you're not sure how your statement of earnings is going to look like, I would literally do the following. I would do this. Write down every single expense that's included on your sheet, because it's highly likely that it's not even highly likely, it's the answer that you need to add. You need to add all of these. As you can see, I'm getting a little bit tired. So we're going to take a break after this one really quickly so I could, grab a little something to eat. But what I want to iterate here is that we obviously need to include every single thing that was in our partial statement. And with that, we need to be able to identify, okay, what or which of those expenses have to be adjusted. And that's why our journal entries are so important, because we're going to cross-reference our journal entry to our expenses that we had in our tentative income statement. And then what we're going to do is super simple, and you're going to love it. So what I want to do here is we have our salaries and wages expense, right? And they said it's equal to 28,500. But what I want to see is did we have any journal entries that related to salaries and wages expenses? Did we have any? Did we have any adjusting entries? Exactly. Yes, we did. Amazing. So if we go to A, we notice that wages expense was 310 in terms of expenses that we need to adjust for. And what does this mean? We made an adjusting entry. We said that wages expenses, $310 of that had to be, Sarah said it best, exactly. We need to add $310 to our salaries and wages expense. So we need to add $310 to 28,500 because there are more expenses that we've incurred in that year, okay? So just like that, we know that we have 2,500 plus 310. So in this case, we're going to have the following. All right. And the same idea applies here as well. So we know that our maintenance expense, right, under partial, under partial income statement was equal to 12,000, right? That means that we purchased 12,000. Why don't we, oh, so Julia said, why don't we subtract? So we know that expenses are debited. So if, let's say we had, let me give you an example. Let's say we had wages expenses, another wages expenses of, so let's say they had unpaid wages for the last 3 days of $310. But then they also had another journal entry that said, hey, we have unpaid wages of $100. So we have another expense to consider. That would mean that not only did we have $310 that we didn't consider, there's also another $100 that we didn't consider that we need to account for. So that means that $410 has to be added to our total expenses, right? You always add expenses together because expenses, once all together, we can subtract that from our revenues. So that's the idea here. That's why we don't subtract it. We add expenses together, but we then subtract our expenses from our revenue. Does this make sense, Julia? Exactly. Nice. Amazing. Cool. Great. So now our maintenance expense. And this relates once again to what we said for this little question here. So essentially, this question is telling us that we had a tentative maintenance expense of $12,000, right? Of $12,000, but this did not consider what was left on hand. So we had $1,000 left on hand. So that means that our actual expense of the totality of the supplies we used, only 11,000 was used. And that's why here, we're actually not looking at our maintenance expense, we're actually looking at our maintenance asset account. our supplies, maintenance supplies asset accounts. Okay. And our beginning balance was of 12,000, but we actually used supplies. So of those supplies, 11,000 was gone, and that's why we have 1,000 left. And for that reason, the actual expense for our supplies is equal to 11,000. And that's why in our maintenance expense section for our statement of earnings, we're going to put 11,000 rather than 12,000 because we used of that total 12,000 only $11,000 worth of supplies. Does that make sense? Make sense to everybody? Like we're all cool with that? You could, it's totally
I
fine.
just have a quick question. Why are you putting the 11,000 and the 28,810 on the left side and the 114 on the right side?
This is just me like being like super nitty gritty, but because, you know, credits are on the right, debits are on the left. So obviously revenues are credits, so I put it on the right, and then the rest, the expenses are debits, so I put them on the left. But you don't have to do that. I just do it for good measure.
But if you put it all in the same column, it's okay?
Yeah, it's fine. It's fine. It's
Okay, cool, thank you.
they're not gonna kill you for that.
Okay.
It's just me being like totally OCD. So with that, now we have our salaries and wages expenses. We have our maintenance expense. So now what's left is our rent expense. Well, not what's left. The next step is our rent expense. So let's go back. Do we have anything related to rent? The answer here, what is it? Do we have anything related to rent in our journal entries?
No.
Exactly, amazing. So it's really easy. It's copy paste. 9,000. Now, if we consider our utilities expense, do we have anything that we need to consider for our utilities expense? The answer is yes. That was A, correct? So if we go back to A, we notice that, actually, no, it's not A, it was B. But if we go to B, we see that utilities expense was debited for $400. And we know that we add expenses together. Therefore, we would add $400 to our $4,000 right here. And that's going to give us what value? What are we going to put here?
4,400.
Amazing. Hell yeah, exactly. Now, do we have anything related to gas and oil? Did we talk about that? Exactly. No,
I don't believe so.
Exactly. No, we did not. So now we have miscellaneous expenses. Miscellaneous expenses were not considered. I mean, like we didn't do any like adjusting entries for that. So now, are we done? Is there an expense that we're missing, or we're good?
We're missing income tax.
We're missing income tax. Yeah, for sure. That's what we're going to do towards the end. Are we missing something else?
Interest expense?
Hell yeah, exactly. And this is a common error that a lot of people are going to make on the exam, but not y'all. Because you always want to look at what's here. See, okay, have I included all my expenses? Have I included all my adjusting entries? The goal of an adjusting entry is literally, word for word, to adjust your financial statements, all of them. So you need to go through every single one of them and make sure that you've driven that change. So in this case, we have our interest expense that we must consider and that we must add to our income statement. So good catch. In this case, our interest expense is a $500. So now with this, we're actually able to find our total, expenses.
Aren't we missing depreciation expense, or we don't add that?
You're a pro. You see, I forgot. Literally an error that even myself will make, So yeah, exactly. So the last one is appreciation expense. It is a non-cash expense, but it's super important. So now our final check, it seems like we have everything. And with this, we're able to find our total expenses. I use the sum function, so you can do equal, SUM, then do a parenthesis.
And income tax we do after total?
Yeah, you'll see how we do it. I'll
Okay.
show you in a second. And that's going to give us our total expenses. Okay. So now, I think we could all agree that what's going to be left, right, is our earnings before income tax, right? We didn't apply income tax yet. Is that correct with everybody? Like, are we okay with that? Like, we have our earnings before income tax. So this, so our revenue minus all of our expenses before our income tax expense. So now we have our earnings before income tax expense. Okay. And we know, if I'm not crazy, yeah, we know that we have all that. But now we have to include our income tax expense. What was our income tax expense? It was 7,000. Yeah. Yeah. Okay, cool. We all have that. So Now we have 7,000. And with this, we're able to find our net income. And that's going to give us our net income. All you have to do is 33,290 minus your 7,000, and that's going to give you your net income. And that's exactly what we're seeking. And it's as simple as that to do your statement of earnings. And you could add like little, des traits if that's what you're into. Like they do it, but they don't expect you to do that really. It's totally fine if you omit that. And just like this, you have what you need. And as simple as that, really. It's really as simple as that. So that's how you do a statement of earnings. Now, before we take a little break to get our senses back and come back energized, do you have any questions? Is there anything that was unclear? Is there anything that you'd like to cover really quickly?
I'm just worried about like the format, just because like I'm not as proficient in like Excel obviously as you are. So like if I just like, because like I did all this stuff on like my spreadsheet, but like it just looks a lot less pretty than yours. Like it's okay, like you're not going to lose marks because of that.
This is like, if I can find my old ones, trust me, it didn't look good. This is just something to be really clear for you, such that when you practice, like within the weekend, you have something to go back to that's not unclear. This is just for me to make sure you have the good stuff. But as long as you have these elements, you're fine. And as long as you
like
practice.
for journal entries, as long as you have your debits and then you indent for your credits and you have your numbers, you're fine.
Fine, man. Like, of course, try your best to like test yourself, right? To try. But then once you have,
make it readable.
take that. Yeah, no, you're fine, man.
Okay, cool.
That's all that matters. Yeah, exactly. So since there's no like common shares outstanding, since they're not talking about anything like that, you do not have to worry about your EPS. You do not have to worry about anything related to your shares right here. Any other questions? We'll take another 3 minutes for questions.
Real quick. So like, should we like show like proof of like calculation for like earnings before income tax, net income, and total expenses?
This is your calculation, right? Like right at the bottom, it's very clear to them. Like they're accountants, so this will make sense to them, 100%.
Okay, yeah, because I'm making sure, because they can't really see the sum function on the.
Yeah, no, this is fine. Like they know that if they're in the same column, you can even bold this if you want to really make it clear, like to really stress it out. But trust me, I didn't do it, and I never like lost anything for that. This is how a statement of earnings looks like. Any other questions or thoughts? imagine we all have to go through it. But yeah, so okay, so we're gonna take 10 minutes. I think an hour is fine to do the balance sheet question. Yeah, we're gonna take 10 minutes. We're gonna get back in our space, and we'll be back. And yeah, so we'll be back at 7:57 to do question 3. Very similar, and we're gonna look at closing entries and all that good stuff. So we'll see each other back at 7:57. All right, perfect. All right. Let me share my screen. Okay. All right, so I hope everybody's well relaxed, feeling good. Just gonna partition my screen really quickly. Sorry if it's a little bit of time. How much? I don't know. Alrighty. Cool. So question 2 is out the way. Question 3 is about to begin. With that said, let's get this party started. So Q3 statement. Yeah. All right. So same thing for everybody here. I would suggest kind of just quickly making your Excel look good for yourself. Cool. For me, that works. I like it like that. Okay, cool. So let's look at this. Let's try to make sense of what question 3 is all about. Now, once again, do not hesitate to stop me if you have any questions. This is for sure recorded, so you're fine if there's any like ambiguities or something of that sort. By the way, if I put do you guys still see me right now? Yes or no? Just put it in the chat.
No, we don't see.
Okay, yeah.
Sorry.
I can
Okay.
see you. I have like a little window of like just your face, then I have like your shared screen like on my screen.
What about this? Can you see me? Whoever said no, can you see me now?
Yeah, no problem.
Perfect. Okay, good. Amazing. So let's look at this question together. Now, we have the Golden Rule Inc. By the way, if we go over 9 p.m., I think this could go like till 9:10. It's totally fine if you have to leave at 9, but I really, there may be some questions that are like left that you want to have answered. So this could go to like 9:10, worst case scenario. With that being said, we have this question, and this is something that's very common that you could see. It's still very important to be able to understand this question and identify the different like skills needed. Okay, so we have a statement of financial position, which is unadjusted. Okay, keyword unadjusted. And with that, with the journal entries that we're going to have to make a few adjustments to our balance sheet. So with that being said, we have a few numbers, cool, amazing. And then they're like, consider the following information. So of course, when they give you following information from A to F, this just means that, hey, you're going to have to do some adjusting entries. You're going to have to consider its impact. And from that, you're going to be prompted to create, a statement of earnings, prompted to create a statement of financial position, and also prepare closing entries. And this is where these questions become really, really interesting for us. And you're going to learn a super duper skill. So as we know, we have requirement A, B, C, and D. I'm going to move back a little bit for my neck. Give me a second. Also going to adjust my keyboard. Yeah, okay, cool. So the first thing that we want to do is we have all this. We're going to start with requirement A. And we're going to do this. So prepare entries. Now, once again, do not worry if it's not as cute. This is just me being extra. And after a few semesters of teaching this course, you kind of get some muscle memory. So let's check this out. So we have journal entry A, and wages owed to employees total $8,000 as of December 31st, 2020. So I'm going to ask you, what do you think we should do here? We're talking about wages owed. Do we do something? Tell me, yes or no? in the chat, or you could raise your voice. Okay, yes, 100%, right? The key word here is that they're saying this is owed. That means that we didn't pay anybody yet. And that also means in this case that because we're at the end of our accounting period and no cash is being administered here, we know that we're going to be dealing with expenses and with payables. So for the sake of being super clear, we're at the end of an accounting period, and we know that owed and not recorded are going hand in hand here. So with that being said, our journal entry will look like this. Okay, simple, clear, simple as we need. That was in there. Whoops. So with that, we have our wages expense. Are we okay with this? Easy, right? Oh yeah. Of course, let me know if there's anything. So with that being said, now we have B, and B is something. Okay, so why is it wages expense and not wages payable? It's a really good question. Now, what I want you to think here, first and foremost, is that, let me ask you, when is wages payable debited, William? When do you think wages payable will be debited?
When wages payable will be debited.
Yeah.
When you.
Yeah, you're there, 100%.
When you credit the, I don't know.
You had it. I know you had it because you went with your gut feeling, then you stopped because you're like, nah, that wouldn't make sense. But
Yeah,
it does.
I can't remember what my gut feeling was though.
No worries. Essentially, wages payable or any other liability will be debited, i.e. increased, when you're incurring more, when you're eliminating, whatchamacallit, let me just see if I'm making sense here. Hold up. Let me just make sure that I'm making sense. Me too, I'm drawing a blank for 2 seconds. I want to give you the theoretical definition. So, yeah, so wages payable, so a liability will be debited if and only if we're eliminating that liability, okay? So when we're adding benefit to our company, debt obligations are not something that we really, really enjoy. And that's why when we are debiting typically assets or liabilities, we're really looking at economic benefits or economic value for the company, something that's good for us. That's the way I would like to frame this for us. So of course we debit assets because this is a good opportunity for the company. An asset is something that's going to create revenue for our company. And for that reason, it's an economic benefit. And for that reason, we're going to debit it. Now, liabilities, we would debit them when we're eliminating liabilities. Okay, so when we eliminate liabilities, we know that we actually are creating a benefit for the company because less obligations in a short-term or long-term basis will be there. I feel like I'm an old grandmaster closing my eyes to make a thought. But with that being said, wages payable here are being credited because we're not eliminating those wages payable. All right, so we're making the assumption that we're actually only writing that down in our journal entries and in our statements and in our balance sheet as of now. And another point that I really want to make super clear is that wages expense have to be debited. And in this case, if they're owed and we didn't even consider them yet, it would be the most logical scenario to add them as being our debit. And for that reason, that's the answer. Now, is that okay? Did that make sense?
Yeah.
Perfect. Okay, so now we get to B. B is something that we did, and we know how to do this. So we know that we have a note receivable that was obtained by the Golden Rule Inc. on September 1st, 2020. All right, so we know we have this one's a tricky one, and it's kind of like a typo-ish, and I'm sure Dennis in the chat, if he's still there, no, he left, remembers this. So essentially, we have a note receivable that was obtained on September 1st, 2020, and a note carries an annual interest rate of 5%. And this will be payable, the note payable will be at maturity only. So this is kind of cryptic. Like, what do we mean by this? And what I like to do here is I really like to identify the things that we do know, okay? And the first step is to use the note that we did last time, right? So we know we're gonna have something related to interest for sure. I think we could all agree. So we know for sure that we have something interest. We have two journal entries, like we have two elements to our journal entry that will be related to interest. But now we need to figure out, well, what will that amount be? And is it going to be interest expense that's going to be, debited, or interest payable, or interest income that's going to be credited? Like, we have these questions, but we have a pretty good intuition here. So the first thing that I would like to do, especially if I'm on the exam and I'm unsure, I would like to identify the stuff that I know, and from there, try to find a value from this. So what do we know here? We know we're talking about this note receivable. Let's go back to the information provided to us and try to identify something that relates to a note receivable. Now, if you go right here, we see that we have a note receivable, okay? So this is extremely important because this is saying that we have a note receivable. So essentially, we're expecting some money in the future. We have a note receivable for 24,000, okay? That's really interesting. We also know that in this question, we're expecting interest of 5% on an annual rate. So annual interest, okay? So right now we're just writing the stuff we know. And I'm sure some of you are super sharp, and all of you are super sharp, but really you understood what to do here and you already have your journal entry. But I really want to break this down into small steps for you, because on an exam you may be stressed, and by having somebody boring like me giving you the step-by-step will give you that opportunity on the exam to remember what to do. So our note receivable is of 24,000. We have an annual interest of 5%. That's amazing. And let's look at how many months have passed. Can somebody tell me how many months have passed since September 1st to December 31st? Exactly. So we know that 4 months have passed. All right. All of September, all of October, all of November, and all of December. 4 months. Okay. So with that, this is the same old classic math that we did. So the interest is going to be equal to 24,000 times 5% times 4 divided by 12. And that gives us the following amount. So now we have a good sense of what we have here. And by the way, if you're a person that wants to write a note instead, you could just do this. Same thing, okay? They all lead to Rome, these paths. So now that we have that, let's try to consider what's going on here. We know we have a note receivable. It's not a note payable. So what you want to know about this means that the company, Golden Rule Inc., actually provided money to a person or a company. So they provided a loan to a person or a company for the amount of $24,000 with an interest of 5%. So this means that the company will pay us the loan back, but they're also expected to pay interest on that loan, okay? They're expected to pay interest on that loan. Now, for those 4 months that have passed, they're expected to pay $400 of interest income, okay? So that's super important. So now we know that we're expecting $400 of interest income, all right? So what will our journal entry look like? I want to test you guys, test everybody here. Are we going to put debit as interest expense? Are we going to put debit as interest receivable? Are we going to put debit as interest income? What are we going to do here? Can somebody try to give it a shot in the chat or by raising your voice?
Interest revenue goes on the debit side.
Why?
Or interest income.
I want you to tell me why. Why do you think that's the case? If you don't feel comfortable to answer, it's totally fine. But
I think so, because then after, actually, I don't know.
Interesting, right? That's good.
Yeah.
So now you'll forget why. Amazing. Julia, why do you think it's interest expense that we're going to put as debits?
I don't know. It just makes the most sense.
It's okay. It's totally fine. 100%. So this, what I want y'all to remember here is that this is our company, okay? We're looking at Golden Rule Inc. And they're telling us note receivable. That means that we're expecting money, right? So we're not paying money to anybody. If we're not incurring any costs, if we're not paying anybody, would we have any expenses? Yes or no? What do you think? What do y'all think?
Can you repeat that?
Okay, so let's say, Julia, I ask you for a loan. I ask you $24,000, all right? And you're like, "Oof, man, that's a lot of money. I will give you $24,000 if you pay me 5% interest." I'm like, sure. Okay. Exactly, Nicholas. Exactly. We're not looking at an expense.
Okay, it's interest receivable.
Yes, exactly. Because you're not paying, and like you're not paying anybody. Somebody's gonna pay you. All right. And because we're doing an adjusting entry, no cash is being like transferred. So you know that you have $400 worth of interest that's supposed to come in. All right. So that's exactly what you're going to debit. Interest receivable. It's like an accounts receivable. You just want to be able to use the term interest receivable. And for that reason, we're going to have interest receivable debited for that amount of $400. Now we know that if we're expecting something, like if we're receiving something, but we haven't gotten the cash yet, and we covered this earlier into our course, what will be our credit? What are we going to credit?
Is it interest payable?
Well, we're like, this is what we're supposed to get, right? We're not paying anybody. Somebody's paying us. Remember what we did with our accounts receivable? What
I
did
think
we
it
credit?
goes
Yeah. What you got?
revenue. It's interest revenue that we credit, no?
Exactly, revenue. In this case, when it's like interest, we call it interest income. All right. But yes, 100%. We're getting like revenue here, but there's no like fee to like interest. Like you don't pay anything when you get interest. Like that's just like a one thing that there's no cost associated to it. And because there's no cost associated to the interest you receive, we call it directly interest income because it's a direct profit. And for that reason, we call it interest income. Okay. But yes, Nicholas, like you had literally the correct answer, but the really like specific answer would be interest income. And that's what we're going to credit. And also remember, if we know, like we could play a puzzle game here. We know for sure that we're debiting an interest receivable. So there's no way in hell that we could like credit an interest expense because first and foremost, we have no expenses. And first and foremost, we know that expenses are never credited like typically. So what is left? What else can we credit? Now we've discussed this idea of payables, but in this context, we know we're not paying anything, especially if we're supposed to receive anything. We're supposed to receive something. So what could be left? Revenue and income. And from there, we know that revenue, well, it is revenue, but because there's no costs, there's no expenses related to that revenue in itself, it's directly profits, so directly interest income. And for that reason, interest income of $400. And that's a long way to say that this will be our journal entry. Now, does this make sense to everybody? Are we okay with this? Amazing. Good. Perfect. Amazing. So now we could go to C. So C is more level-headed. C says that the balance in prepaid rent represents a payment August 1st, 2020 for 12 months of rent beginning on that date. Now, this is a really bad way to say the following. Let me like say this better. The balance in prepaid rent represents a payment on August 1st, 2020 for 12 months of rent beginning on that date. So what we're saying here is that the balance in prepaid rent right here of 16,800 represents a payment on August 1st, 2020 for 12 months of rent. In other words, this amount right here that we have, okay, is equivalent to 12 months of rent. Now, this is the same old classic thing that we're doing. We need to look at how many months have passed since August 1st, and then we'll get a better sense of what's our actual rent expense and what will be the balance of our prepaid rent. So with that, can you tell me how many months have passed? All right, how many months have passed since August 1st, 2020? 5 months, exactly. I'm pretty sure 5 months, exactly. Yes, it is 5 months. So 5 months have passed, all right? And we know that the balance is 16,800 at the beginning. So what is that? 16,800 divided by 12, because we know we have 12 months, right? And then we know that we have this, wait, August, September, October, November, December. 5 months, right? 5 months. 5 months for since we made that payment, right? And then because we know that that prepaid rent balance represents 12 months. So what we do is we do 16,800 divided by 12. That's going to give us our payment per month. We know 5 months have passed. So we could do that amount times 5. And that's going to give us a value of $7,000. So now we have a value, all right? We have a value here. What will our journal entry look like? Because we know that expenses are only recognized when incurred, and we know that we paid all of the rent up front, but we actually didn't live in that place at that day that we paid. And now that we're doing our adjusting entries at December 31st, we know we lived at that place for 5 of that 12 months. So technically, we've expensed, like we actually used that place for 5 of those 12 months. So that's amazing. So we know that now, okay, we have rent expense that we're gonna debit. We're gonna debit rent expense because we know that we actually used the unit, the place, the space for 5 of those 12 months, okay? And for that reason, we could say that our rent expense is 7,000. Now, Nicholas, you're a G, exactly, 100%. Because we know that our prepaid rent represented all of the rent expense that we're supposed to have over a year, we know that what's left of prepaid rent will be 16,800 minus 7,000, but the credit we're doing to our prepaid rent will be equal to $7,000 as well. Like we're going to reduce 16,800 by 7,000. All right. So that's just the perspective to have here. And just like that, if you wanted to include a note, like for a question like this, you would say, I would do this. Like if I wanted to make a quick note, 12 months equals, I'm not mistaken, 1,400 multiplied by 5 months equals 7,000. Like that's one way to make a quick note. And that's enough for your teacher, like they'll understand. And just like that, you're able to make a journal entry. Now, does this make sense to everybody? Are we cool with this? Are we jamming with this? Amazing. Okay. So now we have question D, and it says the following. The equipment has a useful life of 20 years. Depreciation expense for 2020 was estimated at $3,000. So what are we going to do here? what are we doing here? What do we do? I think we
doing depreciation expense and then accumulated depreciation expense.
For how much?
Not expense, sorry, accumulated depreciation.
Exactly. And for how much?
For 3,000.
There you go. Oh yeah, 100%. Aussi simple que ça. And because there's no like other, non-current asset or long-lasting asset, you don't have to worry about like writing, a specific term here. Like this is fine. This is totally cool. Sorry about that. So yeah, simple like that. Now we have E. E is pretty cool. E is really, really interesting. And E is just something that you need to be slightly logical about, but it's not complicated. So cash dividends of $1 per share were declared on December 31st, 2020, and it's payable in the future, like not now, okay? So now we first and foremost know that cash dividends were declared, okay? So there's a few things I want you to remember here. First and foremost, rule number one, cash is never used in an adjusting entry at the end of an accounting period. So it's not because you saw cash that you're going to add cash to your journal entry. This is a trick. They're evil people. So what you want to remember here is that dividends were not paid yet. We're saying that dividends were declared. And in the question, it says that dividends are payable on January 25th. So it's in the future. So already now you could eliminate a few possible accounts that you could use. So now the next step is that we're discussing this idea of per share. What is our per share? How many shares do we have? So this is always going to be given either in your text or just simply within your balance sheet that was provided to you. So now, obviously, we see that contributed capital is equal to whatever amount, but we know that we have 15,000 shares outstanding. And this one is half right, and I'll show you why. So the first step is I want you to know what accounts are we going to use here. So in this case, retained earnings is what we're going to use as our debit here. Retained earnings essentially is where, as soon as we have a declaration of dividends, is where we're going to take money out of it. Okay. And retained earnings is super synonymous with anything with revenue and profit and income. If you understand this, earnings is profit that you kept. And retained earnings is literally profit that you kept from year to year. Let's say we had $5,000 worth of profits or earnings last year, and we have $10,000 worth of profit or earnings this year. Our retained earnings will be equal to the sum of those two. So $5,000 plus $10,000, i.e. $15,000. That is going to be our retained earnings. So when we declare dividends, this is us paying our shareholders from the bag of cash, the bag of profit, the bag of retained earnings that we have. So if we declare dividends of $1 per share for 15,000 shares, essentially what we're going to do is something super simple. We're going to do 1 times 15,000. Okay, and that's going to give us $15,000. And because as soon as dividends declared occurs, we know we're pulling that money or whatever from our retained earnings immediately. We now know that we're going to debit our retained earnings. Now, what did I mean by retained earnings being similar to profit? Now we know what this means in a logical fashion. But if we know earnings and retained earnings and profit and net income and just income and revenue are super synonymous with retained earnings, this means that if we were adding to retained earnings, it means that we would credit it. But if we're taking away, if we're decreasing, if we're taking money from retained earnings, that means that we would have to debit it because it's the total opposite, right? So that's something to consider. And for that reason, retained earnings would be debited in this case when we have dividends declared, especially for your first exam. Now, on the other hand, Nick, you were totally right, 100%. Dividends payable is what we're going to credit because liabilities, once they're created, are credited. For that reason, dividends payable of $15,000. Now, are we okay with that lengthy explanation? Any questions about this idea? I know it's not the clearest sometimes.
I actually have a question. What is it gonna always be retained earnings? When is it? When do you debit dividends declared?
That's going to be something that you're going to cover for the final exam. But for this, this specific exam, don't even worry about that.
Okay, because we did have some problems where we needed to know, or like debit or credit dividends declared. So I have a feeling that they're probably gonna put that.
You want to send it to me? Maybe I could look at it after the crash and like give you. We could make a group, by the way, on Facebook, like, or Messenger, and like that. If you have any additional questions, like that you maybe want to have covered quickly, or like have a quick solution, I'd be more than happy to do that. So you can send that to me, and I'll like put it in our group for everybody that was here, or I'll put it in like the website on the member page, and I'll cover it for you.
Yeah, sure. I'll find it and send it to you.
Amazing. So yeah, 100%. But honestly, by doing retained earnings, typically you're like 99.9% okay. So don't worry about that too much. And I'll cover the question just in case. But for the scope of this specific problem, we're going to go with this approach. So yeah, now we have this and this. Now finally, for F, it's the classic, the classic income tax expense. But this one is slightly interesting because there is some like sort of caveat. And F says that the company is subject to an income tax rate of 20%. Income taxes are due March 15th, 2021. Now that's not like, we don't care about that. But what we know is our income tax rate of 20%. Well, what do we do with that? You're telling us, hey, you have your income tax rate of 20%, but we don't even know what's our income yet. We don't even have that in our data. Like, whoa, what am I supposed to do with this? Where is my income? So this requires us to actually make a statement of earnings to be able to answer F. And that's a trick. It's, just another way to make this slightly more difficult. So for now, F, there's nothing really that we can do. However, what I want to say, and obviously on the exam, you just do your statement of earnings first. Like once you see F, like, okay, well, I have to do that. So don't worry about that. But what I would definitely recommend is always look back at your balance sheet. And what we notice here, and I'm gonna put this in like another color, we see that we have an account called prepaid income taxes, okay, of $1,000.40. Now this is really relevant. Because first and foremost, and you've read this in my notes, and you'll also see this in my past recordings, is that anything that's like considered to be prepaid is considered to be an asset. So prepaid rent is an asset for a company, right? It's future benefits, it's future opportunities for us to raise capital in the future. Prepaid income taxes would be considered an asset. Now, when we have an income tax expense, we're definitely going to have to credit that prepaid income taxes, because we know that that's just a benefit for us to pay less, or for us to have less income tax payable. So that's something that we're going to look at in detail when we make our journal entry for F. But for now, let us go straight to building our statement of earnings. All right. So now you're a pro, and you know exactly how to build a statement of earnings. So I'm going to go a little bit quicker for this because we've literally just covered a question on this. So, but when we get to the balance sheet and once we get to closing entries, that's where we're going to be like really focused on. But this is going to be crucial for us to do our F, journal entry. Perfect. So as per usual, oh, sorry. I'm so sorry about that. F is we can't, so F says the company is subject to an income tax of 20%, right? Our income tax rate is of 20%, but we don't know what's our income yet. Like if we go back to our question, we have all these different accounts, some of which are related to a financial position, some of which are actually related to our statements of earnings. So it's like, it's totally all over the place. So with that information and with our adjusting entries, we're going to be able to create a partial statement of earnings to get a sense of what's our income. And then we could apply our tax rate to our income. And from there, we're going to be able to make our journal entry. So it's quite a few steps to get to the answer here. Does that make sense? Amazing. Perfect. So with that, the classic, sorry about that. So with that, we get the classic revenue, So once we look at our data, we know that our sales revenue is equal to 301,000. So we could put sales revenue. In this case, it's 301,000. Now do we see if we have anything related to revenue here? Always something to do. We know we have interest income. That's super duper relevant, but that's something that we're going to add, and we can add this at different places and you'll see how that works. So in terms of like direct revenue that has to be expensed in some sort of way, we don't have anything. So now we have this. Amazing. So with this, we need to we have a different topic. We have another topic in our balance sheet right here. We have this idea of cost of sales. All right? Cost of sales is like the expenses of all expenses. You always take off cost of sales before you start taking off like your other expenses. This is something that, listen, you don't have to like make it form, like you don't have to format this in a very specific way. You don't have to like stress about this, but just know that when you have cost of sales, I would suggest just doing the following. So you could do cost of sales. This is just me being OCD there, but we know our cost of sales is of $129,000. So with that, you're going to be able to get your gross margin. It's going to be equal to following. And listen, I know this is kind of like trippy, but this is just a first step that you want to be able to have. And, you know, it's just common practice. Okay, so now we have our gross margin. Now, once you have your gross margin, you're able to apply your operating expenses, or essentially you're able to apply all the different expenses that you have right here, as well as the expenses we've covered here. Okay, don't worry about this too much. What you want to be able to do is just put all of these elements into your statement of earnings, and then try to break them down and segment them as much as you can. But don't stress about this too much. You just want to be able to identify what actually goes in a statement of earnings, what actually does not go in a statement of earnings, such that you get the right net income. And like that, you'll be able to complete F. So, you know, little thought of encouragement there. So with that being said, what we want to be able to cover before we begin is I would like to really identify all the expenses that we have in our little like table, such that we're able to add them here. Okay. So we know that we have some other operating expenses. Cool. We know that we have, okay, some rent expenses. Amazing. And we know that we have wages expenses. Pretty dope. Amazing. Cool, cool. It seems like we don't have any other expense, right? Amazing. So with this, what we do is, as we've seen last time, we always add the expenses provided in our section right here. And then we go back to our journal entries to see if there's any adjustments or any additions to be made in terms of our expenses. So now we could add our rent expense. And then we have other operating expenses. But because it's other operating expenses, I typically add it to the end. But you could also just add it like right underneath. It's really up to you. So now what we're going to do is we're going to go back through all of our stuff. And we're going to see if there are additional elements to be added. So we're going to go one by one. So A, we see that we have a wages expense of $8,000. And we cross-reference with this right here. We know that we have already wages expenses of $111,800. So all we're going to do is add this value to this value. So with that being said, what we're going to have for our wages expense will be $111,800 plus 8,000. That's going to give us $119,800. So that's our first step. Then we know that we have our rent expense. So let us go see what's in our rent expense. Do we have any adjusting entries for that? And we do. We have rent expense of $7,000. Literally rinse and repeat. So we take our $7,000 And what's interesting here is that we're going to add that to our rent expense. We're going to add that to 11,000. Okay. And something that I want you to understand is maybe you have a question like, well, why aren't we reducing that? Why aren't we decreasing rent expense by $7,000? Well, that's not how it works. Expenses are always added up and bunched together, right? So that means that in the past we had an expense for rent, and now we have another expense for rent. So we need to add them together. But you're definitely thinking in the right direction. And we're going to look at that once we're in our statement of financial position. So with that being said, we had $7,000, if I'm not mistaken. We're going to add that to our $11,000, and that's going to give us $18,000. Okay. Now our other operating expenses, listen, we obviously don't have other operating expenses like as a title. So what we could do is we can just add this as 1,400. However, as you know, there are other expenses that we covered within our adjusting entries. So let's take a look and try to define them and find them. So this A, we did. B, well, this relates to interest income. C, we've covered. And then E does not relate to anything compared to expenses. So all that's left is D. Now D, what we need to look at is we need to see, we need to look at our initial data to see if there's anything that we could add to depreciation expense. So as we said, well, it doesn't seem like we have anything related to this idea of depreciation expense, but we do have accumulated depreciation. But that does not go on our statement of earnings. That does not go on our income statement. So for that, we have our depreciation expense of $3,000. Now, because it's good measure, if I were you, I would literally just do this, put your operating expenses underneath, because they're like weird random expenses. And like that, you could find your total operating expenses and essentially use your sum function. You add all of them up together, and that gives you a value. Okay, that's going to give you a value. And like that, you have all of your other operating expenses. Okay, so now this is interesting. If we go back to, and this is a tip, by the way. So let's say you're doing this exam and it's the first time you've seen these elements. It's the first time you've seen this question. And that's totally possible. Well, one way to get a sense of what you're doing is to really like identify everything within this section right here and see, okay, have I identified all our revenues? Have I identified all of our expenses? Amazing, that's the first step. Then has these expenses or has these revenues flexed or fluctuated with my adjusting entries? Okay, you see, okay, nice, amazing. We covered most of them. So now what's left is E and B. So what's interesting with B is that we're discussing this idea of interest income. Income, revenue, should be added to our income statement. So that's something to understand. So how does it affect our statement of earnings? So one way of doing this is to write down the following. So now we have our earnings or our net operating income. So you could write that if you want there, but you have your earnings from operations. They're going to be equal to the following. Right? This is what we're making from our operations. This is our net operating income. This is our earning from operations. Essentially, what we're doing here is we're saying anything, right? We're taking our gross margin, we're taking off our total operating expenses, and this is going to give us our earnings from operations. Essentially, what we're saying is that we want to find how much earnings we have before we add our additional earnings, our additional income. And in this case, our additional income, our other income, would be our interest income, which was related to B, right? We had this thing right here that we need to add because it is income, and we need to add that to our statement of earnings. All right. For that reason, we have $400 as our interest income. Okay, we have $400. All right. So now, once we have this, we're able to have all of our earnings after our operating expenses, but before our income taxes. Okay. So now we have, So how did we get earning from operations? Amazing. Really good question. So what we did is we had our revenues, then we decided to reduce our cost of sales. Then we took off all of our expenses, right? This is just a bunch of names to do the same thing, by the way. We're doing revenues minus expenses to find our profit or loss. Like, remember that's what we're doing. Right now, we're just being fancy. We're going in depth. I'm trying to prepare you for like the hardest possible thing, okay? So essentially, we had our revenues, right? We had all of our revenues, like our main revenues. Then we had this special sort of expense. We had to take that off. Then we had to take off all of our other operating expenses before our actual income tax expense. And that gave us this value. This value is what we're going to call our net operating income, or simply our earnings from operations, okay? And that gives us 29,800, okay? Simply, you did this minus this, which gave you this value. Once you had this value, you subtracted all of your expenses that you do as usual. And that gave us your total earnings from operations. So essentially you did this minus this. And what's cool is that you get my Excel sheet. And with my Excel sheet, you get to find these values right here, and it highlights it for you. So you really get a neat way to reverse engineer these questions and also to review parts of this recording and review the problem when you make your own Excel. So now we have our interest income, yeah? And then we get our earnings before income tax, i.e. EBIT. You're gonna see that in the future. But yeah, so now, whoops. Now you have the following. Essentially what you're gonna do is you're gonna do 29,800 plus our interest income. And that's gonna give us the following. All right, so give us the following. Now we know that our income tax expense is going to be based off our income tax rate of 20%. Where did we get that 20% of our income tax rate? Well, we got it right here. Remember? To complete F, they told us that the company is subject to an income tax of 20%. So we know that whatever we have as our earnings before income tax, we're going to have to apply a 20% rate to that. And that's going to give us our actual income tax expense, right? So now all that we have to do is equal this times 0.2 to find our income tax expense. And that's going to give us the following value. All right. And because we're super duper like pros, what we're going to do is the following. To find our income or our net earnings, whatever you want to call it, we call it net income just for to make this like clear. Essentially, our net income is going to be equal to the following: 30,200 minus our income tax expense. That's going to give us our net income. Now, somebody mentioned this idea of our earnings per share. And in this case, we actually want to find our earnings per share. Why do we want to find our earnings per share? It's because we know in this question, we discussed this idea of 15,000 shares. So as soon as you have anything mentioning shares, shares outstanding, common shares outstanding, you want to be able to take your net income and divide it by whatever amount of shares that you have. Okay, so in this case, we know that our earnings per share with 15,000 outstanding will be equal to 24,160 divided by 15,000 shares. And that's going to give us our earnings per share of $1.61. Okay. And with that, we have a full and comprehensive statement of earnings. All right, you're really getting your reps in. All right, and now let me ask you, what will we put for F? Like, what should we do there? What's our journal entry? Can somebody tell me? What's our journal entry for F? And I'll bring you back to F really quickly. The company is subject to an income tax of 20%. Income taxes are due March 15, 2021. What would be our journal entry for F? Our
The
adjusted.
income tax expense after earnings before income tax. Well,
And
after.
it's-
Well, yeah, that one, yeah.
Perfect. Okay, amazing. And what will I debit? What will I credit? What am I debiting? What am I crediting? Am I crediting expenses? Am I crediting payables? Am I crediting income taxes? What am I doing?
Aren't you crediting income tax expense? No, sorry, debiting income tax expense and crediting income tax payable?
You're on the ball. You're amazing. Yes, of course, that's what we're doing. So our income tax expense, right? Because we have an expense, that's our journal entry. We're trying to see what happens with our expense. Now you've discussed this idea of the income tax payable, right? That's what we've been doing since the very beginning. However, one little caveat, and this is the sharpest of the sharpest. We have our prepaid income taxes. Remember that? And our prepaid income taxes is an asset. It means that we already paid income taxes in excess in the past. So we have this asset of $1,000.40 that we could use towards our current income tax expense. Essentially, what this means is that because we have this asset, our liability of income tax payable, what we owe in the future, could actually be less. Let me give you a concrete example, while also like writing it down for you. So why did we do this? And this is really important. And let me give you like a concrete example from the real world and how it will apply to us IRL. Let us say that we all pay taxes, hopefully. If you don't, tell me how. But we all pay taxes, and sometimes we could pay taxes in excess. For example, we paid $5,000 in taxes, but we only really had to pay $4,000. This means that we paid $1,000 too much. Now, for companies, what happens is that they get what we call prepaid income taxes, or they decide to pay income taxes in advance. So we create this asset, we create this safety net because we paid taxes in excess in the past. This means that we're obviously not going to pay more taxes in the future. We're going to use that safety net, that fund, to pay our taxes when they arise. So in this case, we paid taxes extra of $1,000.40. So we get to use this to reduce our income tax payable, such that it actually becomes $5,000, such that when we actually end up paying income taxes in cash, we're only going to pay $5,000 instead of paying $6,040 in cash. So let me give you an example, right? So when we actually pay our income tax payable in the future, like on March 5th, we would be debiting our income tax payable by $5,000 and paying cash and crediting cash, essentially, so paying cash by $5,000. Now, obviously, that is very much different than what we could have paid if we didn't have this asset of prepaid income taxes. Because if we didn't have this, we would be paying here $6,040 instead. But because we have this asset, we get to save in taxes in the future. Does this make sense to everybody? Do you understand why we did that? So, oh yeah, essentially, because we know we have prepaid income taxes, and we know that's an asset, and we know that because we have prepaid income taxes, we're able to pay less in taxes in the future, i.e. our future obligation towards taxes, i.e. our income tax payable will be less. So because we have $1,040 here, which comes from this spot right here, we're able to actually pay much less in our income tax payable. Like our future obligation will be equal to our tax expense minus our prepaid income taxes minus that asset, such that our income tax payable, our future obligation is equal to $5,000 instead of the classic 6,040. Does this make sense? Amazing. So what we're doing here is we're just leveraging, we're using our asset, our prepaid income taxes to our advantage. It's the same idea as what we did with our prepaid rent, which was right here, the same concept. So this is just a different way to look at it. And this is how we get to our journal entry for F. Are we okay with this? Can we move on to maybe the whatchamacallit, the balance sheet? Perfect. Okay. So now we could make our statement of financial position. In the statement of financial position, let me just connect my computer. Sorry, it's dying on me. So the statement of financial position really relates to the classic assets equals liabilities plus shareholders' equity. And essentially, a statement of financial position is literally looking at a journal entry, looking at the accounting equation, but at scale, at a macro scale, such that when we're looking at this, we're looking at our assets, we're looking at our liabilities, we're looking at our shareholders' equity. So what we're going to do here is we're going to do the following. In this case, everything's on the same side, so don't worry about it too much. So when we're doing our assets, we're going to look at our current assets. Essentially, our current assets is literally every single thing that's not considered to be long-lasting. So essentially, when we're looking at long-lasting assets, we're really thinking about PPE. So whatchamacallit, property, plant, and equipment. So essentially, what we're doing here is we're just going to look at everything we had in our initial little statement of financial position, and we're going to add them to our balance sheet on Excel. So with that being said, we're going to use red. So this means that we're looking at our accounts. We're doing our assets. So we're going to start with every asset that we could see. So we have accounts receivable, that's an asset. Do we add our accumulated depreciation to our current assets, or do we add that to our long-lasting assets, or do we add that to assets? Like, what do we do with this? Can you tell me?
Wait, real quick, for statement of financial position, don't we put like for like the specific date?
Yeah, exactly. So for the year ended December 31st, 2020. Does that answer your question?
Yeah, for sure.
Perfect. So yeah, so for sure, accumulated depreciation will be a non-current asset. So we're still going to underline it just because it's cool. Of course, cash is a asset. Deferred revenue in this case, will we consider it as an asset? Let me see if that makes sense. Do we want to do that? No. In this case, I'm going to say no. Give me a second. I'm just trying to make sure if I could add that or not. In this case, deferred revenue. For now, we're not going to consider that as being an asset. So now we have our equipment at cost. So that's an asset as well. In this case, it's going to be considered a non-current asset. Merchandise inventory is considered an asset because inventory is an asset. In this case, our note receivable is just, once again, another receivable. And because it's within the next year, we could consider it being a current asset. Prepaid income taxes is definitely a asset. Prepaid rent is an asset. Rent expense is not an asset. Retained earnings is not an asset. Sales revenue is not an asset. And wages expense is not an asset. So now that we went through all that, we're able to get a better sense of how we're going to make our statements of financial position, especially the asset section. So the most classic asset is cash. So cash is equal to 11,000. And at the end, what I like to do is I just like to add everything to my statements of financial position. And then after that, I make any adjustments needed. Or if I remember one, I go straight to it. So we have that. Then we have our accounts receivable. Equal to 100,000. Then we have our merchandising inventory, so our merchandise inventory. And that's equal to 18,200. Then we have our note receivable. And that's equal to, whatchamacallit, I believe it's 24,000. Yeah, 24,000. Then we have the other elements that we've discussed. So because we're doing current assets, we're gonna go look at the different elements that we have to consider. So if we go back to our journal entries, we're looking at wages expense. Equipment, in this case, I would consider it as a non-current asset because equipment could be like, for example, like a parachute for a Navy SEALs team. It's a weird example. A parachute for like the Army. Maybe a parachute could be used like 20 times, like the insides of the parachute, not like the actual parachute itself. Maybe there's ways to recycle it. Or for example, like equipment like soccer ball. On a soccer ball, you typically wouldn't use it just once. You would use it like for maybe a year, or maybe 2 years. So stuff like that. So equipment is not necessarily like current. So then if we look at B is interesting because we're discussing this idea of interest receivable. So interest receivable, because we're expecting interest with like, especially within a year, we know that that could be considered an asset. So in this case, we're going to put it as interest receivable, $400. Now another interesting asset that we did not add, and I'll put it right here, would be prepaid rent. Prepaid rent is super dope. It's super interesting because we had a prepaid rent of 16,800. However, we also had a adjusting entry in which we had to credit our prepaid rent. So what will be our prepaid rent in our balance sheet? What's going to be the value? What do we do with that?
9,000.
It's going to be 9,000 or maybe 9,000 something. Maybe check your zeros, check your numbers, but you're on the right path.
Okay, I'm using your chart and I can barely see like the number. That's why.
Okay, yeah, but really quickly, yeah, 100%. So what we did is that we took 16,800, which was our prepaid rent account at the very beginning, but then we credited prepaid rent by $7,000. Therefore, our prepaid rent fund is actually going to be 16,800 minus 7,000. For that reason, that's going to give us 9,800. All right. So prepaid rent is going to be equal to 16,800 minus 7,000. So 5 months worth of rent. And like that, we have all of our current assets. Now, if you want to be on if you're into that good stuff, you could just write this right here as the sum. So all your current assets. All right. So you can do that. And now we could look at, for example, yeah, why not? So now we could look at our non-current assets. Right, so we could look at our non-current assets. Yeah, fine. So our non-current assets, what are our non-current assets? There's only one right here that we kind of dealt with. It's our equipment at cost. So when you have non-current assets that are especially dealing with depreciation, because we have depreciation expense right here, we also have a journal entry related to depreciation expense, you need to look at that non-current asset, but you also need to look at your accumulated depreciation. So with that being said, how is that going to work? Let me show you. So we have our equipment at cost. So our equipment at cost is equal to the following. And we're going to put it here. You'll see why. Our equipment at cost is equal to $60,000. That's the cost of our equipment when we purchased it. However, non-current assets depreciate. So every year they kind of lose value. Okay. So with that being said, we need to look at our depreciation expense, but we also need to look at our accumulated depreciation before we made our adjustment. So let me show you what we do. So we know that we had accumulated depreciation of $9,000 before our adjustment. So now we need to add the depreciation expense we've incurred during that period, which was of $3,000. Because every year our equipment, our non-current asset, is losing value. So the depreciation has to be added, clumped up together every single year. In other words, they have to be aggregated and added together, such that our depreciation expense, or our accumulated depreciation, is actually equal to 12,000. Okay, and with that, you're able to find your actual value of your asset, which is going to be equal to 60,000 minus 12,000, and like that, you're able to find the value of your non-current asset, i.e., the value of your equipment. Does this make sense to everybody? Like, was this fair?
Sorry, how did you get the 12,000 again? Real quick.
So yeah, for sure. So right here, we have $9,000, right, as our accumulated depreciation before the adjustment. Yeah.
Yeah, sounds good.
Okay. And then we had to do an adjusting entry, right? We had this adjusting entry in which we had to consider the depreciation expense for each. Yeah.
Sir.
Yeah, exactly. So
Yep.
what we do is we just add them up together, right? So 9,000 plus 3,000, because now we have more accumulated depreciation.
Perfect. That makes much more sense.
Perfect. Amazing. Good. I'm happy to hear that. And with that, now we have all of our assets together. So you could add, like right underneath it, you could add, total non-current assets. Like this is just me being like super particular, but like it's totally fine. It's like you're chilling. You don't have to do that. I mean, no, I wouldn't worry. Sorry about that. Let me just separate this a little bit. Okay, so now with this, you actually have your total assets. And to do this, all you're going to do is 48,000 plus your value right here. And that's going to give you your total assets. Okay, so now we have this. This is amazing. I'm super happy. We have all of our assets. All that is left to do is looking at our liabilities. So our liabilities, essentially, it's the same old game. We're going to look at our values. So we have accounts payable for 33,000. We are going to consider deferred revenue as a liability because that is revenue. That is a service that we are obligated to provide to a consumer or a customer in the future. So it's a future obligation. A deferred revenue essentially is a future obligation. For example, let's say you received cash for a service that you did for somebody. So let's say you paid me, some of you paid me before the crash course, but I didn't give you the crash course yet. In fact, the crash course is not even done yet. So prior to the crash course, I had deferred revenue, but because of that, that causes a future obligation to you. You paid me. So now I owe you a really good crash course. That's the idea for deferred revenue. Deferred revenue is an obligation because now you owe your customer that thing that you promised them and for which they paid you in cash. And for that reason, deferred revenue is considered to be a liability. Also, with that being said, we have, it seems like we don't have anything else that we need to consider here other than, let me make sense of this. So yeah, it seems like we have most of it. So now we have our two liabilities from our data. However, we know this by now that we need to look at our journal entries. So at A, we notice that we have wages payable. Amazing. We also notice that we have, for example, At F and at E, we have dividends payable and we have income tax payable. So we need to add these three to our statement of financial position. And with that, we're able to add our accounts payable. We're able to add our wages payable that we had. We're able to add, what was the other one? Income tax payable. We're able to add dividends payable, and we're able to add deferred revenue. And for that reason, we know that our accounts payable is equal to 33,000. And that's because we have it right here. We know our wages payable when we did our adjusting entry is equal to 8,000. We know our income tax payable was equal to 6,040, if I'm not mistaken, or no, it was 5,000. See, I made a little error there. It was income tax payable of 5,000. So that's what we're going to add to our data set. We know that our dividends payable, right, is equal to the following, 15,000. And then we know that our deferred revenue is equal to 11,240. So now we have all of our liabilities. This is the good stuff. We're happy. We're really happy about that. So now we have our total liabilities. Now let's take a look. You know what? I'm going to bring this here just because it's nicer. Give me a second, just clean this up. Perfect. So now we need to look at our shareholders' equity. This is fairly honestly fairly simple. It's possible, but honestly, non-current liabilities, and let me make sense for this. Let me make sense of this. Essentially, the distinction between current assets or liabilities with non-current assets or liabilities is the following. Current assets and liabilities are within a year. Okay, so within a year's time. Will that thing or account change within that year, or will it be concluded within that year? All right. Now, on the other hand, non-current assets and non-current liabilities are things that are projected to last more than a year. So for example, equipment is projected to last more than a year. For example, a debt to a bank that's due in 5 years lasts more than a year. So for that reason, it's considered to be a non-current liability. So when you have these like non-current liabilities and non-current assets, you want to express judgment. You want to be able to think, well, when is this due? When will this change? And will this ever like change at all? And with that, you're going to be able to see in which section it goes. Does this answer your question?
Yeah, perfect. Just to sum it up, so it's like non-current liabilities is just like things you have to pay for further than a year.
Exactly.
Yeah, okay, perfect.
Exactly. So shareholders' equity is the last step. Okay. So we could use dark orange. Shareholders' equity is really, and if you read my notes, you have a really good sense of what shareholders' equity is. It's essentially financing that's exchanged for equity into the firm. So have you ever seen Dragon's Den or Shark Tank? They always say, you know, I want $100,000 for 5% of my company. Wow, good for you. You value your company to be worth quite a lot of money. But what's interesting here is that you're essentially getting financing. You're getting money. But in exchange for that money, you're giving them a portion of your company. In other words, you're giving them equity into your company. So shareholders' equity is financing received in exchange for equity within your company, i.e. stake in your company. So with that being said, contributed capital is another term to discuss this idea of equity. Essentially, contributed capital, it relates to common shares, okay? So you've issued shares on the stock market or internally or within a private group, and in exchange for a share into your company, they gave you money. Then retained earnings is another portion of shareholders' equity, because the money you have after debt, after expenses, is what we call equity. Is what you've earned. It's the money, the earnings you have, the profits. And that, when it's retained over time, is still equity. So that's something that you put within shareholders' equity. So obviously with that, we have our contributed capital. Yeah, and then we also have our retained earnings to consider. Simple as that. So when it comes to our contributed capital, it's very simple. All that we have to do is look at what's in our data right here, and we have our contributed capital equal to 60,000. So 60,000 is our value. Now with retained earnings, what I want you to be able to understand is the following. Retained earnings, and I'll draw it here, although very bad. Let's assume that you had earnings for year 1, okay? Then you have earnings for year 2, okay? Then you have earnings for year 3, i.e. you have profits in year 1, you have profits in year 2, and you have profit in year 3. Retained earnings, okay? Retained earnings is equal to the sum of these 3. So you take your profit from year 1, so you take your net income from year 1, you take your net income from year 2, you take your net income from year 3, and you add them all up together, and you get retained earnings. That's this concept. So with that being said, if we have retained earnings of $70,000 at before we make our adjusting entries, this essentially means that we're going to have the following, okay? So we're going to have $70,000 because that was all of our earnings before we actually got our net income from this year, okay? So naturally, if we know that retained earnings is just the sum of all of our earnings, the first thing that we want to do is take our beginning retained earnings and add our net earnings from this period. So how we do this is we're literally just going to take our net income right here. We're going to add that to our $70,000, okay? But then there's one last step. The last step is, remember when we discussed the journal entry for D? When we discussed this concept, we said that when we issue dividends, when we pay out dividends, we take that money, that cash, from our retained earnings because we're taking it from our equity. And so because we're taking it from our equity, we actually have to reduce whatever we paid out in dividends payable or whatever we promised in dividends payable. This is super important. And one thing that I want to say with that is think about it logically. This is going to help you for future courses and for the final. When we have shares, right? These people that invested into our company who purchased our shares are owed some of our money because they're also owners of the company, even if it's very, very small. So what this means is that when we pay them, we have to pay them from our money because they are owed that money. So they have a hand in all that. And it's for that reason that we actually subtract retained earnings when we have issued dividends. And for that reason, our retained earnings will be equal to the following, okay? So to summarize this, we took our beginning balance of $70,000, we've added our net income, and we've subtracted whatever we paid out as dividends. And that's how we get our retained earnings. And with that, we get our total shareholders' equity. And a really good way to make sure that you got the right value here, okay? A really good way to make sure that you got the right value here. Let me just make sure this is good. Yeah, a really good way to make sure that you got the total value here is to do the following. Once again, we remember that the accounting equation states that assets is equal to liabilities plus shareholders' equity. We want that accounting equation to balance at all times. And that's where we get this whole debit equals credit. So this is how you verify if you're doing okay on an exam. That's how you verify it. All right. Give me a second. format this slightly better. Okay, so with that being said, what we want to see is we want to see what's our liabilities plus our shareholders' equity. And we get the following. This is interesting. What we want to see is our total assets equal to our total liabilities and shareholders' equity, i.e. is A equals to L plus SE. Can you tell me if that's true? Hell yeah, exactly. So because of this, you know that you got the right answer. Because of this, you know you have the right answer. So for example, let's say you only added 70,000 plus our net income. This would not balance. This would not be equal to this, right? Does that make sense? Like, do we get that? So we know that we made an error. And because of that, we're able to assess if we're in the right path. And that's why it's extremely important to consider what has happened to our retained earnings. And that's how you build a really top tier, like best of the best statement of financial position on your exam. And your teacher is going to be impressed. It's going to be like, who's this person? How did they do this? And this is how you get top marks on your statement of financial position when you have something of this pedigree. And it doesn't have to be nice like this. As long as you know what goes in and how to adjust for that, you're getting top marks. Any questions? Any ideas here? Are we okay? Like, do we feel okay with this? Like, do you feel empowered? Do you feel like you have the good stuff? Good. I know it's late. I know like all of our brains are kind of fried right now. Especially you're stressed. You have other stuff to do. I'm sure all of you work or whatever. So I get it, 100%. So with that being said, this is going to be the last part of our crash course. We went 20 minutes over. I don't want to go 45 minutes over. But what I want to say is that with the recordings that are going to be posted this evening, with this recording as well, you're going to be able to get a better sense of how you do closing entries. And I'll put a specific video just for that, like on the thing. And essentially closing entries, I'll give you a solution added to this Excel, and you'll see how to break it down. And there's also a past recording that's going to show you how to do it. But if we do this, we're going to do 4 hours, and it's not going to be feasible. And that's why we have the past recordings, because it's going to give you an opportunity to be able to see what has to be done there. With that being said, I do want to give you an opportunity for like 3-5 minutes to ask any questions, because this is the best time to do so. It's fine if you're exhausted, I get it. Okay. So I get it, 100%. So with that being said, this will be the end of the crash course. What I want to show you now is that if we go back to the website, at the end, so in an hour, you will find our recording right here. You will find the solutions right here. You will find our past recordings right here. I'm going to add a note for everything that we've discussed into this crash course right here. So you'll have all the important information or all the clarifying elements that we've had to discuss. Now, another point that I would like to carry is, listen, students on this mock, on the exam, do fairly poorly. It's because this is a new course. It's because it's probably like their first like hard class at JMSB. It's because they don't have somebody that's giving you every single tip that you need to succeed. And that's going to give you an opportunity to be amazing to your teachers. Because what I showed you right now is an amazing way to get top marks. This on your exam will differentiate you from all the other students. So trust me, you're doing the right thing right now. You're the one that's awake at 9:21 p.m. that put their own money on the line to do well in this course. Don't doubt yourself. You're doing amazing. Do all the problems that are provided. You are doing amazing. Do what I've recommended. Review the videos. Spend some time working, and you will definitely do better than, so much better than the average. On average, my students do extremely well. On average, my students typically add 10 to 15% to their grades when they work. I have students who got A+ in 217. I know you guys can do this. I know every single one of you can do this. So that's like my spiel. And with that being said, at 10:30, everything will be available on the website. And yeah, it was amazing. It was a pleasure. It was really fun. And if you have any closing remarks or questions, now's the time. And yeah, my pleasure. Pleasure.
All right, so pretty much we can do like the closing entries on our own, and then it'll be posted.
Yeah, it's gonna be posted like right now.
Okay, that's even better. We learn more of that from that.
Perfect, exactly. And I'll make a group, and we could all communicate with each other.
All right, thank you. Good luck, everyone.
Good luck, everybody. You got this. All right. Have a good evening.
Thank you. Have a good night.